Welcome to the ACI 3I0-012 Dealing Certificate Exam Prep course. This content is for informational and entertainment purposes only and does not constitute financial, legal, or tax advice. Always consult a qualified professional before making financial or legal decisions. Furthermore, this is an unofficial, independently produced course. It is not affiliated with, endorsed by, or connected to the ACI Financial Markets Association in any way. All trademarks belong to their respective owners. In this opening chapter, we will establish the necessary foundation by deconstructing the structure of the ACI Dealing Certificate exam and outlining the core subject areas you must master for success. If you are aiming to distinguish yourself in the global financial markets, the ACI Dealing Certificate is the gold standard for demonstrating your technical competence. This course is specifically engineered to cut through the noise, providing you with a pragmatic, high-probability strategy to pass this exam on your first attempt. We bypass unnecessary filler to focus exclusively on the quantitative and theoretical principles that define the actual assessment criteria. You will gain a clear roadmap for your studies, ensuring that every hour you invest translates directly into confidence and competency for the test environment. The ACI Financial Markets Association organizes the exam into 5 primary baskets, and our curriculum mirrors this official architecture to ensure comprehensive coverage. We begin with the financial markets environment, which sets the stage for technical mastery, followed by a rigorous deep dive into foreign exchange and rates, specifically covering money and interest rate markets. Next, we extend into FIC derivatives, where the complexity truly scales, before finalizing our technical exploration with the financial markets applications section. By understanding how these domains interlock, you are not just memorizing discrete facts, but learning how to navigate the full scope of the exam. Regarding the assessment itself, the exam is a multi-choice platform that demands both conceptual clarity and calculation speed. You can expect a consistent weighting between theoretical reasoning and quantitative application, meaning that you must be equally comfortable interpreting market behavior as you are executing interest rate or derivative formulas. We will map our lessons back to these specific topic baskets, allowing you to gauge your progress and identify areas where your intuition needs further sharpening. The goal is to move beyond mere familiarity, reaching a state of proficiency that allows you to calculate and respond to market scenarios with absolute precision under the pressure of the testing environment. I look forward to our journey through these complex topics. Hello, and welcome to this session where we will establish the mathematical foundations of fixed income and money markets. In this chapter, we will master the simple and compound interest calculations that underpin virtually every instrument you will encounter in the exam. If you are aiming to pass the ACI Dealing Certificate exam, mastering the mechanics of interest is not just an optional skill, but the absolute bedrock of your success. This course has been engineered to transform how you approach complex financial equations, stripping away the mystery to reveal the simple algebra that governs capital markets. You will gain the ability to navigate through interest rate scenarios with precision, ensuring that when the exam clock is ticking, your calculations remain swift and accurate. By focusing on the core principles that regulators and traders use daily, you will build the technical competence required to excel in the global financial landscape. We have stripped away the noise to provide only the essential frameworks needed to pass the certification and apply these concepts in real-world scenarios. Simple interest is the elementary starting point for short-term money market instruments, where interest is calculated solely on the original principal amount. The formula is expressed as the product of the principal, the annual interest rate, and the time period measured in years. If you hold a deposit for less than a year, you must adjust the time factor by dividing the number of days by the convention of the market, which is typically 360 or 365 days. Because this method does not account for interest earned on previous interest, it remains the standard for simple interbank loans and short-term debt. When you solve for components like the rate or the principal, you are effectively isolating variables in an algebraic equation to find the missing value. Practitioners often prefer this approach in money markets because it allows for transparent, linear calculations over short durations. Accuracy here requires a disciplined approach to identifying the day count basis, as a mismatch between the rate convention and the time factor will inevitably lead to an incorrect result. it is vital to recognize that simple interest lacks the exponential growth component inherent in longer-term investments, making it unsuitable for multi-year capital market placements. Compound interest represents the reality of long-term capital markets, where the interest generated in each period is added to the principal to form a larger base for the next calculation. This process, often described as earning interest on interest, is mathematically expressed by applying a power function to the principal value over the specified number of compounding periods. When you encounter instruments with annual, semi-annual, or quarterly compounding, the frequency of these intervals significantly impacts the final future value. A higher compounding frequency leads to a higher effective yield, even if the nominal annual rate remains exactly the same. To calculate the future value of a capital sum, you multiply the principal by the factor of 1 plus the periodic interest rate raised to the power of the total number of periods. Unlike the linear nature of simple interest, compound interest models demonstrate exponential growth, which is critical for valuing bonds and long-dated structural instruments. You must be comfortable converting between nominal rates and effective rates when the compounding conventions differ across various financial products. Mastery of these exponential transformations is necessary to avoid significant valuation errors in any multi-period setting. Distinguishing between nominal and effective annual rates is a common challenge for many candidates, yet the logic remains grounded in a clear set of rules. The nominal rate acts as the stated annual percentage before adjusting for the compounding frequency, while the effective annual rate reflects the true interest earned after accounting for all compounding effects within the year. When you change the compounding frequency, the mathematical relationship shifts, requiring you to carefully recompute the rate to maintain an equivalent value. For example, a nominal rate of 10% compounded semi-annually results in a higher return than a 10% rate compounded annually. When solving exam problems, always verify the compounding frequency specified in the instrument documentation before plugging the numbers into your calculator. Failing to correctly account for the compounding period will lead to systematic errors that propagate through your valuation models. Rely on the power function to bridge the gap between periodic rates and annual figures, as this is the most reliable way to maintain consistency across your calculations. By treating these as fundamental algebraic exercises rather than abstract concepts, you demystify the mechanics of yield production and enhance your analytical speed. See you in the next lecture. Welcome back. In this lesson, we will examine the technical mechanics of day count conventions and the mathematical formulas required to reconcile interest accrual across different financial markets. In the world of professional treasury and fixed income trading, the passage of time is rarely as straightforward as simply counting calendar days. Financial instruments rely on established day count conventions to determine how interest accrues, which introduces a layer of convention-based precision that you must master for the exam. The most common convention you will encounter in money markets is the actual/360 method, often referred to as the money market basis. Under this rule, we count the actual number of days that have elapsed between two dates, but we divide that figure by a fixed denominator of 360 days. This means that if you hold an instrument for one full year, you are technically earning slightly more than the stated annual rate because your divisor is smaller than the actual number of days in a year. Conversely, the actual/365 convention is frequently applied to specific currencies or instruments where a higher degree of precision relative to the calendar year is required. Here, the numerator remains the actual number of days elapsed, but the denominator is adjusted to 365, effectively aligning the interest accrual more closely with a standard non-leap year. When dealing with leap years, market participants must be explicitly aware of how their specific counterparty or clearinghouse handles the extra day in February. In some conventions, February 29th is included in the count, while in others, it might be ignored depending on whether the year is treated as 365 or 366 days. This discrepancy is a frequent source of operational risk, and understanding the specific convention mandated by your jurisdiction is non-negotiable for error-free execution. Moving beyond money markets, we encounter the 3360-day count convention, which is fundamentally a simplification technique common in corporate bond markets and certain long-term debt instruments. Under this convention, every month is standardized to exactly 30 days, resulting in a theoretical year of 360 days regardless of whether the actual month has 28, 29, 31, or 30 days. While this might seem illogical compared to the precision of the actual methods, it provides a stable and predictable payment schedule that simplifies accounting for long-dated liabilities. When calculating interest, the formula requires you to take the difference between the dates while treating every month as a 30-day block. This method drastically reduces the complexity of interest calculations for bonds that might otherwise have varying accrual periods due to their maturity dates. The actual mathematical conversion between these baselines is where most candidates lose points on the certification exam. If you are comparing a money market instrument using actual/360 against a bond equivalent yield using actual/365, you cannot simply look at the nominal percentage rates. To reach an accurate comparison, you must normalize the accrual basis by converting the yield into a common denominator. This involves adjusting the interest amount by the ratio of the day count conventions, effectively stripping away the convention-specific bias to reveal the true economic return. Mastering this conversion requires you to treat the day count as a variable within your rate equations rather than a static constant. Once you internalize how the denominator influences the effective yield, you will be able to resolve mismatches in international treasury calculations with confidence. Calculating the precise number of days between two arbitrary dates requires a disciplined approach, especially when crossing maturity dates or varying currency holidays. You must assess the start date and the end date according to the specific business day convention associated with the currency, such as the modified following business day convention. Once the payment dates are finalized, the day count fraction is calculated based on the designated convention, and the interest is derived by multiplying the principal by the rate in the time fraction. Remember that consistency is the hallmark of a professional trader, and even a minor deviation in your day count inputs can lead to significant discrepancies over large notional volumes. By practicing these conversions regularly, you will ensure that your treasury reports and pricing models remain accurate in any market environment. See you in the next lecture. Welcome back. In this lesson, we will examine the mechanics of discounting and how we arrive at the present value of future cash flows within money markets. To understand the core of modern finance, we must first distinguish between interest-bearing instruments and discount instruments. An interest-bearing instrument typically pays a periodic coupon, where the return is explicit and clearly defined by the principal and the interest rate. Conversely, a discount instrument is issued at a value below its face amount, and the return is realized as the difference between this purchase price and the redemption value at maturity. The fundamental economic principle connecting these concepts is the time value of money, which dictates that a unit of currency today is worth more than the same unit in the future. To equate these two positions, we utilize the discounting mechanism, which strips away the interest component from future cash flows to determine their current or present value. Mastering this operation is essential for pricing virtually any short-term liability or asset in the interbank market. Without a firm grasp of these mechanics, it remains impossible to decompose the value of complex interest rate products effectively. The mathematical foundation for this involves the use of a discount factor applied to a projected future receipt or payment. If we define the future value as the amount to be received at maturity and the discount rate as the annualized market yield, we calculate the present value by dividing the future value by 1 plus the product of the rate and the time fraction. This is the simplest linear approach for instruments with a maturity of less than 1 year, often utilized in money market applications. However, the calculation complexity increases when we account for multi-period discounting, where the impact of compounding becomes the primary driver of value. In these scenarios, simply applying a linear rate can lead to significant valuation errors because it ignores the reinvestment opportunity or the exponential nature of interest accrual. When market yields fluctuate, these discount factors are dynamically adjusted, causing an inverse movement in the present value of the instruments. We observe this sensitivity most acutely when dealing with longer-dated assets, where the duration, the time-weighted average maturity, amplifies the effect of yield curve movements on the present valuation. Constructing a cash flow timeline is the first step in any valuation exercise, ensuring that all future liabilities are captured precisely as they will occur. By mapping these flows, we can calculate the internal rate of return, or determine the price to pay for a stream of future payments. For instance, if an institution anticipates a payment of 1 million units in 90 days, the discount factor must account for the specific day count convention and the prevailing market deposit rates for that period. We essentially solve for the present value by discounting every individual cash flow individually and summing them up, a process often referred to as bootstrapping when applied to yield curves. This methodology allows market participants to decompose future liabilities into their present-day cash equivalents, providing a standardized basis for comparing instruments of varying maturities and structures. Even in environments with changing market conditions, this rigorous approach to present value optimization remains the bedrock of institutional hedging and investment strategy. Consistency in applying these formulas is what separates accurate traders from those relying on overly simplified heuristics that crumble in competitive trading environments. See you in the next lesson. Welcome back. In this chapter, we explore the mathematical frameworks necessary to normalize disparate yield metrics, ensuring you can identify relative value across the complex landscape of financial instruments. When we approach the money markets, the primary challenge is not the math itself, but the lack of standardization in how rates are quoted. If you compare a treasury bill quoted on a discount basis against an interbank deposit quoted on an add-on interest basis, you are effectively comparing apples to oranges. To make an informed trading decision, you must be able to convert these figures into a common denominator, typically the money market yield or the bond equivalent yield. The money market yield, often called the yield on a discount basis, utilizes a 360-day-year convention, which is the industry standard for most short-term paper. Understanding this requires you to remember that the discount is calculated on the face value, whereas the yield is calculated on the actual price paid. By mastering this conversion, you avoid the common trap of underestimating the true economic return of a discount instrument. The formula for the money market yield, often expressed as a discount yield, relies on the difference between the face value and the purchase price, divided by the face value, and then annualized using the day count fraction. If we take a discount rate of 5%, for example, we must remember that this is a simple interest calculation that ignores the compounding effect over time. Conversely, the bond equivalent yield brings us closer to a standardized comparison by using the price paid as the denominator instead of the face value. This transition is critical because it adjusts for the fact that you are investing a specific amount of capital to receive a larger amount later. When you normalize these two measures, you can finally see which instrument offers the superior return, assuming all other risk factors remain equal. This is the bedrock of relative value trading in the money markets. Moving into the realm of effective annual yield, we encounter the necessity of compounding, which reflects the real-world growth of capital when interest is reinvested. In short-term money markets, traders often use simple interest for quick calculations, but long-term planning requires us to account for the impact of reinvestment on the overall return. The effective annual yield converts a periodic rate into an annual figure that accounts for compounding within the year. While the calculation is slightly more involved than simple interest, it prevents the distortion that occurs when comparing instruments with different payment frequencies. A dealer who ignores the compounding effect will inevitably misprice an instrument, leading to suboptimal investment or funding choices. By applying these formulas consistently, you ensure that your portfolio decisions are based on the actual time value of money rather than arbitrary quote conventions. To convert a discount rate quotation directly into a money market yield equivalent, we must work through the mechanics of the specific day count convention in use. The transformation is fundamentally a rearrangement of the pricing formula, where we solve for the rate given a known price and tenor. If you have an instrument quoting a discount rate of 4% with 90 days to maturity, you first find the dollar discount and then relate that to the amount invested. This conversion is essential for repo desks and commercial paper traders who must reconcile various market quotes throughout the global financial system. When you perform these calculations under exam conditions, keep a close watch on whether the request asks for a 360-day or a 365-day-year basis, as this is the most common source of error. Precision in these foundational calculations effectively eliminates the noise created by archaic or heterogeneous market quoting styles. Identifying relative value is the ultimate goal of these mathematical exercises. as it dictates the profitability of institutional cash management. When presented with two instruments, one yielding a discount rate and the other an add-on interest rate, your first step should always be to normalize both to an annual percentage yield. This process reveals which asset provides a higher return for the same level of credit risk and liquidity profile. When funding a position, you repeat this logic by looking for the cheapest source of capital, which again requires a common yield baseline. By training yourself to perform these conversions reflexively, you gain a significant edge in your daily professional practice and during the certification assessment. The ability to look through a quote to the underlying yield is the mark of a seasoned money market practitioner who understands the mechanics behind the screen. I will see you in the next lecture. Welcome to our discussion on determining interest rates for non-standard time periods. This chapter focuses on the mathematical precision required to price financial instruments when market benchmarks do not perfectly align with your target maturity. In the real world of professional trading and treasury management, you rarely encounter contracts that align perfectly with standard market tenors. While a central bank may quote rates for 1-month or 2-month intervals, your specific cash flow requirement might fall exactly 40 days into the future. When you face these so-called broken dates, you cannot simply guess the rate based on visual proximity to a benchmark. Instead, you must apply linear interpolation to define a precise position on the yield curve. This technique assumes that the relationship between two known data points is a straight line, allowing for a predictable and consistent valuation of the instrument in question. Understanding this logic is fundamental because it provides an objective, repeatable methodology that regulators and internal auditors demand during the valuation process of illiquid or bespoke assets. To correctly perform this calculation, you first identify the two nearest benchmark tenors that bracket your target instrument's maturity date. If your target is a 40-day deposit, you would look at the 30-day and 60-day market rates as your primary inputs. You then calculate the difference in the number of days between the two benchmark tenors to establish the total interval. Next, you determine the percentage progress, or the weight, that your target date holds between these two benchmarks. For example, if you are 10 days into a 30-day gap between two benchmarks, you are exactly 1/3 of the way through that interval. This relative weight is then multiplied by the spread or difference between the rates of the two benchmark tenors to arrive at the interpolated yield adjustment. Mathematically, the formula follows a standard linear progression where the interpolated rate equals the lower benchmark rate plus the product of the rate spread and the time fraction. By maintaining this consistent straight-line approach, you effectively eliminate valuation gaps that would otherwise permit arbitrage opportunities between standard and off-tenor instruments. It is important to emphasize that this method relies heavily on the quality of your input data. If your benchmark rates are not representative of current market conditions, your interpolated result will inherit those inaccuracies. You must always ensure that the day count conventions used for your benchmark rates are consistent with the conventions of the instrument you are pricing. Mixing conventions, such as using Act 360 for one leg and Act 365 for another, will invalidate the interpolation and lead to incorrect pricing outcomes for your portfolio. Consider a scenario where you need to price a money market instrument with a 40-day maturity, while the market provides a 1-month rate of 5% and a 2-month rate of 5.4%. You define the 1-month rate as 30 days and the 2-month rate as 60 days, creating a 30-day gap between the benchmarks. Your target of 40 days represents 10 days into that 30-day spread, which is exactly 1/3 of the interval. The total rate spread between the two benchmarks is 40 basis points, meaning that 1/3 of the interval accounts for an additional 13.33 basis points over the lower benchmark. Adding this to the initial 5% rate gives you an interpolated rate of 5.1333%. This systemic approach is your best defense against arbitrary pricing and provides a clean mathematical trail for your valuation workflows. As you apply this logic to foreign exchange instruments or forward rate agreements, the complexity remains the same despite the different underlying assets. You are essentially building a localized curve segment that connects two liquid points, providing a synthetic data point where none existed before. If you ignore this exercise, you introduce noise into your risk management system, as you'll be miscalculating the present value of your future cash flows. Precision at this stage prevents the accumulation of small, compounding errors that can significantly impact the overall profitability of a trading desk. always view these broken dates not as inconveniences, but as opportunities to apply rigorous mathematical standards that prove your competence in the face of complex market demands. By isolating the time fraction and weighting the benchmark spread, you guarantee that no matter the maturity, your pricing remains tied to the underlying reality of the yield curve. I will see you in the next lecture. Welcome back. In this lesson, we are going to explore the mechanics and economic implications of the term structure of interest rates. The term structure of interest rates, often represented by the yield curve, is an essential tool for any financial professional. It maps the relationship between the time to maturity and the yield to maturity of zero coupon bonds of the same credit quality. When we look at this curve, we are essentially visualizing the market's expectation of future interest rates and the compensation required for holding debt over different horizons. Understanding this relationship is not just an academic exercise, but a requirement for anyone dealing in derivatives or fixed income products. If you cannot read the shape of the curve, you cannot accurately price the risk that you are taking on. We will start by examining the core theories that dictate why this curve takes the shapes it does. The expectations hypothesis posits that long-term interest rates are essentially reflections of the geometric average of expected future short-term rates. Under this framework, investors are indifferent between holding a single long-term bond or a sequence of short-term bonds that lead to the same maturity. However, this theory assumes that investors are risk neutral, which we know is rarely the case in real-world markets. The liquidity preference theory corrects this by suggesting that investors demand a premium for holding longer-term assets due to the associated price volatility and lack of immediate liquidity. Consequently, this theory explains why yield curves are often upward sloping, as the term premium must increase as the duration of the debt grows longer to entice market participants. We must also consider the market segmentation theory, which suggests that the market for interest-bearing securities is divided into distinct segments based on maturity. According to this view, supply and demand within each specific maturity segment determine the interest rates for that slice of the curve. Institutional investors, such as pension funds or insurance companies, often have specific liability profiles that force them into certain maturity brackets regardless of the returns available elsewhere. This explains why we sometimes see anomalies in the yield curve that the expectations hypothesis alone cannot justify. By combining these theories, we begin to see that the shape of the curve is a composite of investor behavior, liquidity demands, and specific institutional constraints. When we analyze the shapes of yield curves, we primarily focus on four formations: normal, inverted, flat, and humped. A normal, upward-sloping curve indicates a healthy economic outlook where investors anticipate growth and potential inflation, requiring higher yields for longer-term commitments. Conversely, an inverted yield curve, where short-term rates exceed long-term ones, is often interpreted as a precursor to an economic slowdown or recession. A flat curve suggests market uncertainty regarding the future direction of interest rates, while a humped curve often reflects a transition period where intermediate-term rates are higher than both short-term and long-term rates. Each of these profiles provides immediate insight into the collective sentiment of the market participants and the anticipated trajectory of central bank monetary policy. Beyond the spot curve, traders rely heavily on implied forward curves to identify structural arbitrage opportunities and price complex financial derivatives. An implied forward rate is the interest rate applicable to a future period, calculated from current spot rates for two different maturities. If a trader notices that the market-quoted forward rates differ from those calculated using the current spot curve, this may indicate a mispricing that can be exploited for profit. Practically, this involves constructing a forward curve that locks in the cost of borrowing for future dates, thereby hedging against the uncertainty of interest rate fluctuations. This mechanism is the backbone of pricing forward rate agreements and swaps, allowing dealers to create synthetic instruments that mirror the maturity profile of their underlying obligations. I look forward to seeing you in the next lecture. Welcome to our session on interbank deposits and loans. Today, we will discuss the architectural foundations of the unsecured funding market and how banks maintain liquidity through these critical credit lines. In the interbank market, we are essentially talking about the engine room of the financial system, where banks lend and borrow unsecured funds to balance their books. These transactions are typically uncollateralized, meaning the lender relies entirely on the creditworthiness of the borrowing institution. Because there is no underlying asset to seize in the event of default, these placements are intensely sensitive to counterparty credit risk. When you observe a spread between a bank's borrowing rate and the risk-free rate, you are looking at the market's assessment of that specific bank's probability of default. These limits are governed by strict internal credit committees that assign a maximum exposure cap to every counterparty, which restricts the amount of liquidity a bank can source or provide in any given window. Operational workflows in these markets follow a rigid life cycle that begins with a bilateral negotiation, often over electronic trading platforms or voice brokerage services. Once the terms such as principal amount, tenor, and interest rate are agreed upon, both parties initiate a confirmation process to ensure that their records match. Settlement typically occurs via real-time gross settlement systems, which transfer central bank reserves between the entities. The calculation of the interest amount involves specific day count conventions, such as Act 360 or ACT 365, which dictate the daily interest accrual on the principal. Failing to align these conventions at the start of the trade leads to operational friction that can necessitate manual reconciliation. As someone working in treasury or risk, mastering these mechanical nuances is not optional. It is fundamental to managing your institution's funding profile. Pricing these deposits requires a disciplined approach to the term structure of interest rates because the cost of borrowing is rarely static. You must account for reference rate benchmarks, which act as the base upon which the credit spread is added to arrive at the final payable rate. If a bank encounters a liquidity squeeze, their borrowing costs will climb higher relative to these benchmarks, signaling stress to external observers and central banks. Central banks monitor these market rates quite closely, as anomalous behavior in the interbank market often serves as a leading indicator of broader macro liquidity constraints. When interbank lending dries up, it signals a systemic lack of trust, which forces institutions to rely more heavily on central bank facilities for their daily funding requirements. This creates a feedback loop where the cost of borrowing increases, further impacting the profitability of bank balance sheets. Think of the interbank market as a diagnostic tool for the health of the entire financial ecosystem. When we monitor the volume and pricing of these deposits, we are essentially taking the pulse of the market's appetite for counterparty risk. If you are preparing for the ACI examination, you must recognize that these mechanics are not just abstract concepts, but are the daily reality of treasury operations. You will need to calculate interest flows using the correct day count conventions while simultaneously keeping the counterparty credit limits in view. Understanding how these structural dependencies interact is essential for anyone aiming to demonstrate competence in managing short-term cash markets. Keep these institutional realities in mind as we transition into the next material. I will see you in the next lecture. Hello, and welcome back to our deep dive into money market instruments. In this session, we will examine the mechanics of certificates of deposit. A certificate of deposit, or CD, represents a debt instrument issued by a bank that documents a time deposit. Unlike a standard retail savings account, a negotiable CD is a money market instrument that can be traded in the secondary market before its maturity date. Because these instruments are negotiable, they provide the issuing bank with a more stable form of wholesale funding compared to demand deposits, which can be withdrawn at any time. When a bank issues a CD, it effectively enters into a contract to pay a specified interest rate over a fixed term. Investors, in turn, hold these certificates as highly liquid, low-risk assets that often yield more than treasury bills due to the underlying credit risk of the issuing institution. Understanding these mechanics is essential for interpreting institutional liquidity and bank balance sheet management. From a structural perspective, certificates of deposit are issued either at par with periodic coupon payments or at a discount with interest paid at maturity. Fixed-rate CDs are common, but variable rate variants, often linked to benchmarks like SOFR, frequently appear in institutional settings to mitigate interest rate risk for both parties. The mathematical foundation for pricing these instruments relies on the day count convention pertinent to the specific market, such as actual/360 or actual/365. For a CD issued at par, the price remains constant, and the yield is the coupon rate. However, for discount instruments, the yield to maturity is calculated by determining the percentage return on the investment over the remaining life of the certificate. This requires precise discounting of the final redemption value back to the present day using the prevailing market rate for the relevant maturity segment. The secondary market for CDs is characterized by high liquidity, provided the issuing bank is a major investment-grade institution. Investors evaluate these assets by scrutinizing the institutional credit risk profile, as the CD is an unsecured liability of the bank. When trading occurs between the primary issuance and maturity, the price is not necessarily par. It fluctuates based on movements in short-term interest rates and changes in the perceived creditworthiness of the issuer. Settlements typically follow standard market conventions involving physical or dematerialized clearing systems. In a dematerialized setup, the ownership is recorded electronically, which significantly reduces the operational friction associated with physical paper certificates. Accurate settlement relies on adhering to the specific T+ settlement cycle dictated by the local clearinghouse or central depository. For a bank, these instruments offer a strategic advantage by allowing them to match the maturity of their liabilities with specific asset-side funding requirements. By staggering the maturities of issued CDs, a bank can manage its liquidity coverage ratio and ensure predictable cash flow management. If the bank requires immediate funding, it can issue CDs to institutional investors who are seeking short-term, low-risk parking spaces for excess cash. This dynamic creates a robust secondary market where institutional participants can adjust their portfolios to meet regulatory requirements or capitalize on shifting interest rate expectations. Because the holder can sell the CD to another investor, the asset provides the investor with an exit strategy that traditional time deposits lack. Ultimately, the fluidity of this market is a testament to the importance of negotiable instruments in modern wholesale banking operations. See you in the next lecture. Welcome back to our discussion on short-term funding instruments. In this lesson, we will explore the structural characteristics and operational dynamics of commercial paper within the institutional money markets. Commercial paper functions as an uncollateralized short-term debt obligation issued by highly rated corporations and financial institutions to fulfill immediate working capital requirements. Because these instruments are unsecured, their successful issuance is heavily predicated on the issuer's high credit standing, often verified by major rating agencies who assign them investment-grade status. The maturity profile of commercial paper typically spans from overnight to a maximum of 9 months, which is a regulatory ceiling designed to exempt many such issues from the stringent registration requirements associated with long-term securities. From a treasury perspective, these instruments serve as a flexible mechanism to bridge the timing gap between cash inflows from operations and immediate liquidity outflows like payroll or accounts payable. By tapping into the commercial paper market, firms can secure funding at rates often lower than those available through traditional bank revolving credit facilities. This efficiency makes them a preferred tool for large, reputable entities managing dynamic cash flow cycles across global markets. While the standard commercial paper is an unsecured obligation, the market has evolved to include asset-backed commercial paper, where the issuance is supported by a specific pool of underlying financial assets. These assets often consist of receivables or consumer loans, which provide a layer of segregation and security, effectively bifurcating the risk from the issuer's general corporate credit risk. Regardless of whether the paper is unsecured or asset-backed, the issuance often involves an underwriting process where investment banks facilitate the placement of the debt with institutional investors like money market funds or insurance companies. To mitigate the perceived default risk, credit enhancement mechanisms are vital, with a backup line of credit being the most common. This arrangement ensures that if the issuer faces temporary liquidity constraints and cannot roll over its maturing paper, the bank remains obligated to provide the cash necessary to settle the holder's claims. Such structural safeguards are essential for maintaining the continuous investor appetite needed for a liquid secondary market. The pricing of commercial paper typically deviates from the interest-bearing bond convention, as it is almost universally issued on a discount basis. The investor pays an amount less than the par value up front and receives the full par value at maturity, with the difference acting as the return on investment. To calculate the price of a commercial paper instrument, we use the formula where the price equals the face value multiplied by the result of 1 minus the product of the discount rate and the term in days divided by the year base. This year base is frequently 360 days. following standard money market conventions, although local variations exist. Furthermore, treasurers and investors must frequently convert these discount rates into true money market yields to compare them against alternative investments like certificates of deposit or bank deposits. This conversion requires adjusting the discount yield to reflect the actual interest earned on the initial capital investment over the holding period, effectively annualizing the return. Active management of a commercial paper program requires a careful assessment of the cost of issuance against the volatility of market liquidity conditions. Treasurers continuously monitor the spread between their commercial paper yields and the prevailing benchmark rates to gauge whether they are accessing the market at optimal cost. If the issuer's credit risk profile deteriorates, the market will demand a higher spread, potentially rendering the commercial paper program less cost-effective than tapping committed bank facilities. Conversely, in stable environments, the ability to issue commercial paper allows companies to maintain a leaner balance sheet compared to carrying excess cash reserves. The synergy between a robust underwriting program, rigorous credit monitoring, and disciplined cash flow forecasting defines the success of a Treasury's short-term funding strategy. Mastering these mechanics is essential for understanding how corporations calibrate their financing mix in the global money markets. I will see you in the next lecture. Welcome back. We are now diving into the mechanics of repurchase agreements, where secured financing meets collateral management in the wholesale money markets. At its core, a repurchase agreement, or repo, is a sophisticated form of collateralized borrowing, where one party sells securities to another with a simultaneous commitment to repurchase them at a specified future date and price. You should think of this transaction not merely as a trade, but as a short-term collateralized loan where the securities act as the underlying asset to mitigate counterparty credit risk. The price difference between the initial sale and the final repurchase represents the interest earned by the cash provider, known as the repo rate. In the current regulatory environment, repos serve as the primary plumbing for liquidity, allowing financial institutions to manage cash balances efficiently while providing high-quality liquid assets as security. If a dealer holds a long position in government bonds, they can use those bonds in a repo market to obtain liquidity, effectively leveraging their position without selling the assets outright. Understanding this mechanism is essential because it forms the bedrock upon which market makers quote prices and manage their capital requirements. When we examine the structure of these agreements, the first thing to consider is the delivery versus payment, or DVP mechanism. This process ensures that the transfer of securities and the exchange of cash occurs simultaneously within the settlement system, thereby eliminating delivery risk for both participants. In more complex setups, such as the tri-party repo, a third-party agent acts as a custodian and collateral manager, handling the selection, valuation, and maintenance of the collateral basket on behalf of the parties involved. This institutional arrangement is crucial because it allows for the substitution of collateral, meaning the borrower can replace specific securities in the basket during the life of the trade, provided the total value remains consistent with the agreement. The classic repo structure requires us to be precise with our calculations, specifically regarding the collateral haircut, which is the percentage difference between the market value of the asset and the cash lent. If you provide $100 million in bonds as collateral with a 2% haircut, the lender provides $98 million in cash, creating a buffer against market volatility. Beyond the classic repo, we frequently encounter buy/sellback variations, which are essentially two distinct transactions that produce an identical economic outcome to a standard repo, but often differ in legal documentation and settlement technicalities. Managing this requires a deep understanding of mark-to-market margin calls, which occur when the value of the underlying collateral falls below the agreed-upon threshold, necessitating additional cash or securities to restore the initial margin levels. These margin calls are not discretionary. They are fixed requirements that keep the secured lending relationship balanced as market prices fluctuate. Furthermore, institutions often utilize these instruments to facilitate short sales, where a trader borrows a security they do not own to sell it in the market, later covering the position by repurchasing the security. In this context, the repo market provides the necessary conduit to bridge the gap between long-term investment strategies and short-term liquidity needs. Calculating the repo interest itself is straightforward, typically involving the principal amount multiplied by the repo rate, adjusted for the specific day count convention of the currency involved. We must consistently track the independent amount, which is an additional layer of collateral that may be required by the lender depending on the perceived credit risk of the borrower. By mastering these formulas and structures, you gain the ability to analyze how leverage is generated across the global financial system and why collateral quality remains the most important variable in institutional risk management. I will see you in the next lecture. Welcome back. In this session, we will examine the mechanics of margin management within classic repurchase agreements to understand how market participants mitigate counterparty and collateral risk. A classic repurchase agreement is essentially a collateralized loan, but its safety relies entirely on the quality and valuation of the underlying securities. Because the value of these securities fluctuates with market volatility, lenders require a margin, which acts as a protective buffer against potential price declines. This buffer is achieved through a haircut, which represents the percentage difference between the market value of the collateral and the purchase price of the repo. If you provide a security worth $100 and the haircut is 2%, you are only granted $98 of cash in return. This ensures that even if the security's price dips slightly, the lender remains fully collateralized, minimizing the risk of loss if the borrower fails to return the funds. However, the protection offered by a static haircut diminishes if the underlying asset's market value becomes highly volatile, necessitating a regular revaluation process. Operational risk is managed through daily mark-to-market workflows, where the value of the collateral is reassessed against current market prices. If the market value of the collateral falls below an agreed threshold, a collateral deficiency occurs, triggering a variation margin call. The math behind this is straightforward. The lender calculates the current exposure, adjusts for the agreed haircut, and compares this to the original cash amount provided. If the resulting collateral value is insufficient, the borrower must either provide additional securities or pay down some of the cash loan. This process ensures that the lender's position remains collateralized to the precise degree originally intended when the trade was first executed. These maintenance calls represent the core operational heartbeat of repo risk management, requiring robust communication between middle office teams to resolve deficiencies before the close of business. Collateral substitution is another frequent occurrence, allowing the borrower to exchange one security for another while keeping the repo agreement intact. This might happen if the borrower needs to reclaim a specific bond to meet a delivery obligation elsewhere, or if the lender decides certain collateral is no longer acceptable. The key requirement here is that the new collateral must maintain the same economic value and haircut requirements as the original asset. During this substitution process, the transaction must remain neutral to avoid triggering a new margin call. Furthermore, we must account for coupon payments occurring during the term of the repay. The standard practice under the Global Master Repurchase Agreement is for the cash payment to be passed through to the original owner, ensuring that the borrower does not retain the interest earned by the asset while it is held as collateral. The most critical aspect of the legal framework governing these transactions is the protection afforded under the event of a default. If a counterparty fails to fulfill their obligations, the non-defaulting party is empowered to immediately liquidate the collateral held to recover the cash invested. This right to set off and immediate liquidation is fundamental to the stability of the repo market, as it prevents the collateral from being tied up in lengthy bankruptcy proceedings. By maintaining strict adherence to the margin schedule and ensuring accurate, timely valuations, firms effectively cordon off their liquidity risk from the creditworthiness of their counterparties. It is this combination of mathematical rigor and preemptive legal structure that allows the repo market to function as a primary source of short-term funding for regulated financial institutions globally. See you in the next lecture. Welcome to our exploration of central bank liquidity operations. In this session, we will examine how monetary authorities actively manage systemic liquidity to influence short-term interest rates. Central banks function as the ultimate arbiters of liquidity within the financial system, maintaining operational frameworks that effectively steer short-term policy interest rates toward their desired targets. By modulating the aggregate supply of bank reserves, they influence the marginal cost of funding for commercial participants, which in turn ripples through the entire interbank market. When a central bank aims to provide liquidity, it often utilizes open market operations, such as repo auctions, where it lends cash against eligible collateral for a fixed duration. Conversely, to drain excess liquidity, The bank might issue its own debt certificates or engage in reverse repo operations to absorb surplus reserves. These interventions are calibrated to prevent excessive volatility in overnight interbank rates, ensuring that the prevailing market cost of money remains tethered to the official policy corridor defined by the central bank. The primary tools available to monetary authorities include standing, lending, and deposit facilities, which act as the floor and ceiling of the interest rate corridor. The deposit facility allows commercial banks to park excess reserves overnight at a specific rate, while the lending facility provides an emergency window for banks requiring liquidity against collateral at a penalty rate. Beyond these standing facilities, central banks rely on open market operations like fine-tuning bond transactions or long-term refinancing operations to address structural or transitory imbalances. For instance, in times of market stress, a central bank might introduce structural liquidity through extended term funding, effectively easing the scarcity of high-quality liquid assets. These operations are not merely academic exercises, but are fundamental to the daily mechanics of financial institutions, as they directly dictate the availability of funds and the appetite for collateral. Statutory reserve requirements serve as another critical lever, acting as a permanent constraint on the liquidity multiplier effect within the banking sector. By adjusting the percentage of customer deposits that banks must hold as reserves at the central bank, policymakers can influence the lending capacity of the private sector and the overall money supply. While these reserve requirements provide a baseline, the daily operational challenge remains the smoothing of liquidity flows to keep relevant market rates within the intended policy band. Dealers must closely monitor these interventions, as shifts in central bank policy or sudden changes in liquidity supply directly impact the pricing of short-term funding instruments. Understanding these mechanics is essential for any professional navigating modern debt markets, as the central bank remains the most influential counterparty in the financial landscape. I look forward to discussing our next topic with you. Welcome back to our journey through the financial markets. In this lesson, we will begin exploring the institutional foundations of the foreign exchange spot market, specifically focusing on its structural mechanics. When we talk about the spot market, we are referring to the immediate exchange of currencies, which theoretically occurs within a standard settlement period. In the traditional institutional FX market, this settlement is defined as 2 business days forward, commonly referred to as T plus 2. Understanding this is crucial because the price you see on a screen is not just a nominal number. It represents a commitment to deliver funds 2 business days after the trade date. Of course, variations exist, such as when dealing with the US dollar against the Canadian dollar, where the convention is a T plus 1 settlement. When you interact with an electronic order book, you are looking at continuous streams of bid and ask prices provided by liquidity providers. The bid is the price at which the market maker is prepared to buy the base currency, while the ask is the price at which they are prepared to sell it. The difference between these 2 points, the bid-ask spread, serves as the primary compensation for the liquidity provider and reflects the market's perceived volatility and depth. In every currency pair, we denote the assets as either the base currency or the quote currency. The base currency is the first currency in the pair, and its value is always set to 1 unit, while the quote currency tells us how much of that currency is required to purchase 1 unit of the base. For example, in a euro to US dollar pair, the euro is the base and the US dollar is the quote. If the price is 1.0850, it means 1 euro costs 1.0850 US dollars. When we discuss price movements, we use the term pip, which typically represents the 4th decimal place, or 1/100th of 1%. If the price moves from 1.0850 to 1.0855, the market has moved 5 pips. This convention allows for standardized communication among traders who are managing vast amounts of volume. Miscalculating these increments can lead to significant errors in position-keeping ledgers, so you must internalize these conventions as second nature. Beyond standard spot settlement, market participants often require adjustments to accommodate liquidity constraints or specific balance sheet needs. This brings us to Tom/Next, or Tomorrow Next, which allows a party to roll a spot position over to the next business day. Essentially, you settle the original spot trade and simultaneously enter an offsetting trade for the following day, effectively pushing the settlement forward. This is a vital tool for institutional desks managing overnight interest rate differentials and liquidity requirements. While this seems like a simple trade, It involves an exchange of interest rate risk, as you are effectively borrowing one currency and lending the other for that day. Managing these roles accurately within your books is essential for maintaining a clean P&L and avoiding unexpected operational risks. Electronic execution today means that professional traders are rarely staring at static prices. They are navigating multi-bank electronic order books that aggregate liquidity from global institutions. These platforms provide a real-time view of market depth, showing you exactly how many units are available at various price points. Dealing with these platforms requires an understanding of how to interpret these volumes and how to manage your own position in real time. As you execute, your position-keeping ledger must be updated instantly to reflect your current long or short standing in any given currency. This tracking is not just for accounting. It is your primary defense against intraday market volatility that could erode your profit margin in seconds. Finally, we must consider the risk side of these mechanics, particularly settlement risk. Historically, the primary danger in the FX market was Herstat risk, where one party delivers their side of the trade, but the counterparty fails to deliver due to insolvency during the time zone offset. To mitigate this, the industry relies on continuous linked settlement, or CLS, a system that ensures the final settlement of both legs of an FX transaction occurs simultaneously. By participating in the CLS network, institutions effectively eliminate the principal risk that would otherwise exist during the two-day settlement window. Internalizing this framework ensures you do not just understand how to price a spot trade, but also how to protect the firm from systemic failure. See you in the next lecture. Welcome back. Today we are delving into the mechanics of calculating cross-currency rates directly from primary pairs. This chapter provides the essential mathematical framework for navigating the foreign exchange markets with precision and confidence. When you look at currency pairs in the market, they're almost always quoted against a common denominator, typically the US dollar. However, a cross-rate calculation becomes necessary the moment you need to trade two currencies where neither is the US dollar, such as the Swiss franc against the Japanese yen. To calculate the cross-rate correctly, you must first identify the base and quote currency components within your primary pairs. If you have US dollar to Swiss franc at 0.9000 and US dollar to Japanese yen at 150.00, expressing Swiss franc to Japanese yen requires dividing the JPY rate by the CHF rate. Mathematics here is strict, and a minor confusion between which value acts as the numerator or denominator will result in a completely erroneous price. You must maintain mental clarity regarding the direction of the quote to ensure your derived rate reflects reality. The complexity increases when you account for the bid and ask spreads, which represent the transaction costs inherent in any cross-currency movement. When deriving an implicit bid for a cross rate, you must combine the bid of one primary pair with the inverse ask of the other to maintain a conservative stance. For instance, if you are buying a cross, your effective price is constrained by the seller's ask in the secondary market. If you are selling, your return is limited by the buyer's bid in that same market. This compounding of spreads is not merely an optional step. It is a fundamental requirement to avoid pricing errors. Failing to net these spreads correctly would imply a narrower market than what actually exists, leading to poor execution or, worse, a false sense of arbitrage opportunity. Triangular arbitrage arises when the market prices of three currency pairs fail to perfectly align with their theoretical cross-rate values. By observing the quoted cross rate and comparing it to your calculated cross rate, you can identify structural anomalies. If your calculated cross bid is higher than the market's cross ask, you have an opportunity to execute risk-free trades. You would sell the currency that is overvalued and simultaneously buy the undervalued cross. This process involves executing three simultaneous transactions to lock in a profit before market participants adjust their quotes. These windows of opportunity are remarkably fleeting in modern electronic markets, as algorithms quickly identify and exploit such discrepancies. Mastery of these calculations demands rigorous attention to the orientation of your primary pairs. Whether the common currency is the base for both, the quote for both, or acts as the base for one and the quote for another, your multiplication or division steps must adjust accordingly. When the common currency is the quote for both, say Australian dollar to US dollar and euro to US dollar, finding the Australian dollar to euro rate requires dividing the Australian dollar to US dollar rate by the euro to US dollar rate. If the common currency is the base for both, you must flip the relationship to find the inverse. Consistency is your best defense against errors in these environments, as the pressure of the exam and the market environment favor those who have internalized these simple algebraic rules. Practice these combinations until you can intuitively determine the required operation without needing to sketch out the secondary equations every time. See you in the next lecture. Hello. Let's explore the fundamental principles behind pricing forward foreign exchange contracts. We will build an understanding of how interest rate differentials determine the movement from spot rates to forward rates. In the world of professional foreign exchange trading, the forward rate is not merely a forecast of where the spot rate will be in the future. Instead, it is a mathematical certainty derived from the law of one price and the absence of arbitrage. If you hold a quantity of a base currency, you have two logical choices for what to do with that capital over a specific period. You could convert it to a quote currency at the current spot rate and invest it at the prevailing interest rate for that currency. Alternatively, you could invest the base currency at its own domestic interest rate and simultaneously sell the future proceeds forward. For these two strategies to yield the same result, the forward rate must adjust to reflect the exact difference in interest rates between the two currencies involved. The core formula for calculating an outright forward price relies on the ratio of the interest rate factors for the two currencies. You take the spot exchange rate and multiply it by the ratio of 1 plus the product of the quote currency interest rate and the time fraction, divided by 1 plus the product of the base currency interest rate and the time fraction. This ensures that the interest earned on the capital in one currency is offset by the cost or gain implied by the exchange rate's forward movement. The time fraction is critical here, as it incorporates the specific day count convention applicable to each currency's money market. For example, the British pound historically adheres to an actual/365 convention, while the US dollar often follows an actual/360 convention, and failure to respect these differences will lead to significant pricing errors. When we talk about forward points, we are essentially looking at the difference between the forward rate and the spot rate, scaled to a more manageable decimal format. If the interest rate of the quote currency is higher than the interest rate of the base currency, the forward rate will be trading at a forward premium compared to the spot. Conversely, if the base currency interest rate is higher, the forward rate will trade at a discount. These premiums and discounts represent the cost of carrying one currency against another, often referred to as the cost of carry. By isolating these points, traders can strip away the level of the spot rate to focus purely on the interest rate spread, which is the primary driver of forward market volatility. Understanding this relationship allows us to identify when the market diverges from theoretical equilibrium, a scenario known as a deviation from covered interest parity. If the calculated theoretical forward rate differs from the actual market forward rate, an arbitrage opportunity theoretically exists for an entity with access to market funding lines. An arbitrageur would borrow the currency that is effectively cheaper on a forward-adjusted basis, convert it at the spot rate, and invest it in the higher-yielding currency while locking in the forward hedge. Because this transaction is risk-free, the potential profits are typically narrow and quickly erased by market participants executing these exact trades. In modern markets, these deviations are often small or restricted by transaction costs, regulatory capital requirements, and the availability of credit lines between financial institutions. To compute these values correctly, you must be precise with your inputs, specifically the forward period and the compounding method. While simple interest is the industry standard for these calculations, the length of the time fraction must account for holidays and weekends in the respective financial centers. When a calculation span crosses over end-of-year periods or other liquidity events, the accuracy of your interest rate inputs becomes paramount for the final result. Always ensure you are using the appropriate bid or offer rates for your funding and investment sides, depending on whether you are the provider or taker of the liquidity. Consistency in applying these formulas is what separates amateur analysis from the professional rigor required by the certification exam. I look forward to seeing you in our next session. Hello, and welcome back to our deep dive into the financial instruments that underpin modern treasury management. In this session, we will examine the foreign exchange swap, a fundamental tool for managing currency liquidity and rolling positions. At the most basic level, a foreign exchange swap consists of two simultaneous transactions. The purchase or sale of a currency for spot delivery, combined with a simultaneous sale or purchase of the same amount for a forward maturity date. Unlike a simple outright forward contract, the swap functions as a single unified transaction between counterparties, effectively swapping currency exposure over a defined time frame. Think of it as a mechanism to exchange currencies today while locking in the return of that currency later, which inherently removes the market risk for that specific period. The economic engine driving this transaction is the interest rate differential between the two currencies being swapped, which dictates the pricing of the swap points. If you hold a long position in a currency that suddenly needs to be rolled into the future, the swap provides the bridge. This dual execution ensures that the net credit risk is confined to the settlement of the swap itself, rather than two disconnected market legs. When we look at the mechanics of swap points, they reflect the cost or benefit of holding one currency over another, expressed as the forward rate minus the spot rate. If you are dealing with a currency pair like euro to US dollar, the swap points represent the difference between the prevailing interest rates in the Eurozone and the United States for the tenor of the swap. When the interest rate of the currency being bought forward is lower than the rate of the sell currency, we encounter a discount, while a higher rate provides a premium. These points are then added to or subtracted from the spot rate to derive the outright forward rate. Corporate treasurers use this logic to manage multi-currency liquidity without necessarily creating new open market risk. By systematic rolling, they align their cash inflows and outflows with their underlying business operations, ensuring that the currency exposure perfectly matches the actual cash flow needs of the company. Short-dated instruments, such as the overnight swap or the tom/next, tomorrow next swap, are perhaps the most frequently utilized variations by institutional market makers. The tom/next swap involves the purchase or sale of a currency for settlement tomorrow, matched against a sale or purchase for settlement the day after. This is the primary tool used to roll a spot position forward when a trader decides to keep holding the position past the original value date. By executing the swap, the trader effectively carries the position into the next day while incurring or earning the interest rate differential for that single business day. Liquidity managers rely on these short rotations to bridge gaps in funding, often navigating central bank cycles or shifting regulatory requirements. It is an operational necessity in market making, as it allows the firm to maintain inventory levels without liquidating the position in the volatile spot market. For a corporate treasurer, the strategic value of the FX swap lies in its ability to separate the cash liquidity obligation from the exchange rate risk. Imagine a company that expects a large USD remittance in 3 months, but has immediate operational expenses in euro. Instead of leaving the euro exposure unhedged, they can use a swap to manage this temporal mismatch between liquidity requirements and the ultimate currency settlement. This allows the firm to avoid the binary choice between holding excess cash that is eroding due to inflation and risking market volatility through constant buying and selling. By utilizing these instruments, the treasurer creates a synthetic liquidity buffer that is insensitive to the fluctuating spot price. The swap is thus not merely a hedging device, but a critical architectural component for ensuring that the global cash pool remains stable and accessible across different regulatory jurisdictions and banking systems. See you in the next session. Welcome back. In this lesson, we will deconstruct the mechanics of covered interest arbitrage to see how market participants neutralize exchange rate risk while capturing interest rate differentials. Covered interest arbitrage is not a speculative activity, but rather a mechanism that keeps international financial markets in equilibrium by enforcing the principle of interest rate parity. When we talk about this, we are essentially looking for a situation where the forward exchange rate deviates from the theoretical rate dictated by the interest rate differential between two currencies. To execute this, a trader must borrow a currency with a lower interest rate, convert those funds into the higher yielding currency at the prevailing spot exchange rate, and simultaneously hedge the future conversion back into the original currency using a forward contract. This creates a risk-free profit because the repatriation rate is locked in at the inception of the trade, effectively neutralizing any currency exposure. If the yield earned in the foreign money market exceeds the cost of borrowing plus the cost of the forward hedge, an arbitrage opportunity exists. In an efficient market, These activities happen so quickly that the inconsistency is erased, pushing rates back into alignment. To evaluate whether such an opportunity is present, we must compare the forward premium or discount with the interest rate differential between the two currencies. If you are operating in a market with a base currency and a quote currency, the theoretical forward rate is derived by adjusting the spot rate by the ratio of the two interest rates over the specific time period. If the actual quoted forward rate is different from this theoretical rate, there is a discrepancy that could be exploited. Let us say you can borrow in a currency with an annual interest rate of 2%, while the investment opportunity in another currency offers 4%. If the forward market is underpricing the foreign currency by an amount smaller than the 2% interest differential, you can lock in a net gain. The process involves borrowing the local currency, executing a spot transaction, investing the foreign proceeds in a money market deposit, and entering a forward contract to sell those proceeds forward at maturity. The mathematical condition for an arbitrage opportunity is defined by comparing the ratio of the interest rates to the ratio of the forward and spot rates. If the forward rate, expressed as the forward price divided by the spot rate, is not equal to the ratio of 1 plus the foreign interest rate divided by 1 plus the domestic interest rate, the market is mispriced. From a practical standpoint, this requires precise attention to the day count conventions of both the deposit market and the forward market. If the forward rate is higher than what the interest rate differential suggests, you enter a long position. If it is lower, you enter a short position. Because the forward contract hedges the entire principal and the accrued interest, the transaction is essentially riskless, assuming no counterparty default. You are essentially creating a synthetic position in the foreign currency while retaining the domestic currency value. But since the forward contract covers both principal and interest, you are effectively immune to the volatility of the spot exchange rate. It is important to remember that these opportunities are often ephemeral in the modern electronic trading environment. As soon as traders identify the mispricing and start borrowing in the low-interest currency, they drive that interest rate up. Simultaneously, their buying of the foreign currency in the spot market and selling it forward in the forward market puts downward pressure on the forward rate and upward pressure on the spot rate. These supply and demand forces act as a corrective bridge until the arbitrage opportunity vanishes beneath the transaction costs. For the purposes of the examination, you should focus on the steps of the cycle: identifying the interest rate differential, calculating the theoretical forward rate based on that differential, and comparing it to the market quote. Understanding this flow is critical because it demonstrates that currency markets are not just driven by trade flows or speculation, but are deeply linked to the cost of capital in different jurisdictions. I will see you in the next lecture. Welcome back. Today we are diving into the mechanisms of non-deliverable forwards and the specificities of trading precious metals. A non-deliverable forward, or NDF, is a cash-settled, short-term forward contract in a foreign exchange market where the underlying currency is typically non-convertible or subject to significant state-imposed capital controls. Unlike a standard forward contract where the underlying principal is exchanged at maturity, an NDF relies on the difference between the contracted forward rate and the prevailing spot rate at a specific reference date, known as the fixing date. The settlement process requires one party to pay the other the net difference in a major, freely convertible currency, usually the US dollar. This structure allows institutional investors to gain exposure to restricted currencies without needing to physically settle the underlying transaction in a local, potentially illiquid jurisdiction. The economic finality is achieved by multiplying the notional amount by the difference between the agreed-upon forward rate and the fixing rate. Because there is no physical exchange of the underlying pair, credit risk is effectively constrained to the net cash settlement amount rather than the entire notional value. This makes NDFs an essential hedging tool for multinational corporations and banks operating in emerging markets where direct local currency settlement is either legally prohibited or operationally inefficient. Moving into the precious metal space, specifically gold and silver, we must first note that they are treated as unique financial assets that behave differently than traditional fiat currency pairs. In the professional market, gold is typically quoted in US dollars per fine troy ounce, where a fine troy ounce represents the pure gold content of a bar or coin. Because metals are finite commodities, their spot pricing is heavily driven by the interplay between industrial demand, store of value expectations, in the cost of capital. Settlement for spot gold follows an industry-standard convention often referred to as T+2, meaning the physical exchange of metal or the finalization of the trade occurs 2 business days after the execution. When trading these assets, market participants must be mindful of the physical weight standards defined by the London Bullion Market Association, which dictates the quality and characteristics of the bars used in interbank settlements. Institutional investors utilize these instruments not merely for speculation, but as a hedge against currency debasement or as an alternative asset class within a diversified portfolio. Understanding the disparity between the electronic pricing of these contracts and the physical constraints of metal storage and liquidity is a fundamental requirement for anyone approaching the ACI Dealing Certificate exam. See you in the next lecture. Welcome back. In this lesson, we will deconstruct the mechanics of forward rate agreements, focusing on their structural pricing and the mathematical relationship between the yield curve and future rate obligations. A forward rate agreement, or FRA, is an over-the-counter derivative contract that allows 2 parties to lock in an interest rate for a specific future period. Essentially, you are agreeing today on the interest rate that will apply to a notional principal amount for a period starting at a future date. It is important to note that no principal is exchanged in an FRA. It is a cash-settled instrument designed purely to hedge against interest rate fluctuations. The contract revolves around a sequence of key dates, specifically the trade date, the fixing date, and the settlement date. The fixing date is when the market reference rate, such as LIBOR or a more modern risk-free rate like SOFR, is observed to determine the final payoff. The contract period defines the duration of the underlying theoretical loan, typically expressed in months, such as a 3-month period starting 6 months from now. Understanding these timestamps is vital because they dictate exactly when the cash flows are calculated and when they are paid. To price an FRA accurately, we look to the cash market yield curve, which represents the current prevailing market expectations for interest rates across different maturities. The fair forward rate is derived by using the principle of no arbitrage, which dictates that you should be indifferent between borrowing over a long period or borrowing for a short period and then rolling over that debt for the remainder of the term. Mathematically, this involves taking the product of the long-term discount factor and the short-term discount factor to isolate the forward-looking rate. If we denote the current spot rate for a period ending at time T1 as R1 and the spot rate for a period ending further out at T2 as R2, the implied forward rate is the rate that equates these 2 paths. We express the formula by compounding the short-term rate and solving for the unknown segment, ensuring that the total return matches the current long-term market rates. If the FR rate deviates from this calculated fair value, traders can theoretically lock in a riskless profit, which is why the market pricing is consistently tethered to these underlying yield curves. Banks utilize these instruments to provide customized interest rate protection to corporate clients who fear rising borrowing costs. For a company expecting to take out a loan in 6 months, an FRA provides a hedge that effectively fixes the interest cost today, regardless of how the market moves before the loan is issued. From the bank's perspective, these contracts are tools for managing curve risk, allowing them to adjust their exposure to shifting interest rate expectations without needing to tap the physical cash markets immediately. Because these are off-balance sheet items, they remain highly liquid and efficient for adjusting granular interest rate duration without the encumbrance of actual principal settlement. When managing these exposures, the dealer must consider the shape of the yield curve, as an inverted or steepening curve will significantly alter the forward rate compared to the current spot rates. This structural flexibility makes the FRA a cornerstone tool in liability, management, and treasury operations within the wholesale banking environment. When we analyze the pricing from a mechanical standpoint, we must be careful with the day count conventions that apply to the reference index. Different markets and different currencies use various conventions, such as actual/360 or actual/365, which directly impact the accrual of the rate. If you fail to account for these conventions correctly in your pricing model, you will introduce a basis error into your valuation that can accumulate significantly over large notional amounts. Furthermore, the selection of the benchmark index, whether it is a term rate or an overnight compounded average, will change how the forward rate is locked in and monitored. Traders must also be aware that the settlement amount is calculated as the difference between the agreed FRA rate and the settlement rate, applied to the notional amount and adjusted for the time factor. This is why the precision of the contract period is so heavily scrutinized during the trade negotiation phase, as even a minor deviation in the day count convention leads to a mispricing of the hedge. See you in the next lecture. Welcome back. Today we are going to unpack the quantitative mechanics behind forward rate agreement settlement procedures. A forward rate agreement, or FRA, is a derivative instrument that hedges against interest rate risk by locking in an interest rate for a future period. On the fixing date, the parties involved compare the agreed contract rate, often called the strike rate, against the prevailing market reference rate for that specific tenor. If the fixing rate deviates from the contract rate, a cash settlement is required to compensate the party who would have otherwise lost out due to the movement in market interest rates. This payment is settled in cash at the start of the loan period, which distinguishes the FRA from other instruments that pay out at the end of the term. Because the payment occurs at the beginning of the underlying interest period, we explicitly account for the present value of the cash flow by discounting it back from the maturity date to the start date. The settlement formula requires four primary inputs: the notional principal amount, the difference between the fixing rate and the contract rate, the day count fraction for the period, and the discount factor. We express the difference between the rates as the fixing rate minus the contract rate multiplied by the day count fraction. If the reference rate is higher than the strike rate, the buyer of the FRA receives a payment from the seller. Conversely, if the reference rate is lower than the strike rate, the seller receives a payment from the buyer. To find the specific amount, we take this interest differential and divide it by 1 plus the product of the reference rate and the day count fraction. This division is the essential discounting step, and it reflects the reality that the money is changing hands at the start of the contract term rather than its conclusion. Let us consider a practical application with a notional amount of 10 million units, a contract rate of 3%, and a reference fixing rate of 3.5% for a 3-month period. Assume the day count convention for this specific transaction is actuality over 360 days. First, we calculate the interest rate differential, which is 3.5% minus 3%, resulting in a difference of 0.5% or 0.005. Next, we determine the day count fraction, which for a standard 90-day period would be 90 divided by 360, or 0.25. We multiply the notional amount of 10 million by this 0.005 differential and the 0.25 time factor to arrive at an undiscounted value of 12,500. To reach the final settlement amount, we must discount that 12,500 figure to account for the settlement timing. We divide this value by 1 plus the product of the market reference rate of 3.5% and the day count fraction of 0.25. The denominator becomes 1 plus 0.00875, resulting in a value of 1.00875. Dividing 12,500 by 1.00875 yields a settlement amount of approximately 12,391.80. This process ensures that both parties are fairly compensated for the interest rate risk based on the time value of money, consistent with standard market practices for interest rate derivatives. Precision in these calculations is paramount, as rounding discrepancies can lead to material errors when dealing with large notional values common in interbank markets. See you in the next lecture. Welcome back to the course, where we turn our attention to the mechanics of plain vanilla interest rate swaps. In this lesson, we will dissect the contractual structures that underpin these fundamental derivative instruments. An interest rate swap is essentially a contractual agreement between two counterparties to exchange streams of interest payments over a specified period. At the core of this structure is the notional principal, which is a theoretical amount used only to calculate the interest payments and is never actually exchanged between the parties. One party typically pays a fixed rate of interest, while the counterparty pays a floating rate based on a pre-agreed reference index, such as LIBOR or a contemporary risk-free rate. These payments are usually netted, meaning that only the difference between the fixed and floating amounts changes hands on each settlement date. This mechanism allows entities to modify their balance sheet exposure without needing to retire or originate actual debt instruments. By decoupling interest rate risk from the underlying asset or liability, firms can effectively reposition their duration and sensitivity to market movements. The operational framework of a swap is governed by standardized documentation, most notably the ISDA Master Agreement, which provides the legal architecture for these transactions. Within this agreement, parties define the calculation period, which determines the time frame for which interest is accrued and paid. You will often encounter payment frequency mismatches, where the fixed leg might be paid annually while the floating leg is paid quarterly or semi-annually. This necessitates precision in day count conventions, such as 3360ths or actual/360, to ensure that accrued interest is calculated with high mathematical accuracy. The floating rate leg is subject to periodic fixings, where the reference index rate is observed on specific dates known as fixing dates. These fixings determine the floating interest payment for the subsequent period, introducing periodic rate volatility into the cash flow profile. Understanding the structural termination options is equally critical for financial professionals. While a swap has a set maturity date, parties may include provisions for early termination or compression if the underlying hedging requirement disappears. Termination options can introduce complexity into the valuation, as the party exiting the contract may be liable to pay the other party the market value of the remaining swap duration. Corporations utilize these instruments to lower their structural funding costs by accessing capital markets indirectly through intermediaries. For instance, a firm with a comparative advantage in issuing fixed-rate debt can swap into floating-rate payments to hedge against falling rates. Conversely, an institution with floating-rate liabilities may use a swap to lock in a fixed rate to create certainty in their future interest expense budget. Across various economic environments, the strategic use of interest rate swaps enables the fine-tuning of interest rate duration. If a portfolio manager anticipates rising interest rates, they can enter a swap to receive floating and pay fixed, thereby effectively shortening the duration of their interest-sensitive assets. This tactical agility is what makes swap structures an indispensable tool in modern treasury management and asset liability coordination. It is not merely a theoretical exercise, but a practical application of financial engineering designed to isolate and trade interest rate risk. When you analyze these structures, always maintain a focus on the net cash flow impact rather than the notional size. By separating the interest stream from the principal, you gain the ability to manage multifaceted risk profiles with granular precision. See you in the next lecture. Welcome back. In this lesson, we examine the mechanics of overnight index swaps and how they function as the industry standard for risk-free interest rate benchmarks. An overnight index swap, or OIS, is a financial derivative where two parties exchange interest rate cash flows based on an overnight reference rate. Unlike traditional interest rate swaps that rely on term reference rates like the London Interbank Offered Rate, the OIS is pegged to a daily benchmark such as the ESTR or the Fed funds rate. The structure involves one party paying a fixed rate, while the other pays the geometric average of the realized overnight interest rate over the term of the swap. This arrangement effectively isolates the credit risk associated with the banking sector because the overnight reference rate is typically a near risk-free, central bank-controlled benchmark. Traders value this instrument precisely because it avoids the credit risk premium that historically inflated term-based benchmarks, providing a cleaner view of market interest rate expectations. By paying the floating leg, the swap participant pays a realized rate rather than an anticipated forward rate, which fundamentally changes the risk profile for liquidity management. To understand the mechanics, we must look at how the floating leg accrues interest through daily compounding. Because the reference rate changes every business day, the swap pays a geometric average of these rates over the accrual period. Specifically, the daily interest rate is applied to the principal and then compounded, ensuring that the total payment reflects the cumulative effective rate for the entire tenor. This mathematical approach is designed to produce an internal rate of return that mirrors the actual overnight cost of funds. If we consider a one-month OIS, the party paying the floating rate is essentially mimicking an overnight loan that is rolled over every single day for the duration of the month. The resulting payment at maturity represents the difference between the fixed rate leg and the aggregated, compounded floating performance. This compounding ensures that the swap remains aligned with the actual liquidity conditions of the central bank, which is why it has become the bedrock of modern discount curve construction. Calculation conventions such as look-back and observation shifts are critical to executing these swaps in a functional business environment. because the actual overnight rate for a specific day is often not published until the following morning. It is physically impossible to calculate the swap payment at the very end of the accrual period without some technical adjustment. To mitigate this, practitioners employ observation shifts, which move the window of observation back by a few days to ensure that all necessary data points are finalized before the calculation date. This lag allows for precise documentation and settlement of the cash flows between counterparties. Failing to account for these shifts would lead to inconsistencies in the mark-to-market value of the swap, creating operational discrepancies. Dealers must ensure their internal systems correctly process these shift conventions against the specific central bank calendar to avoid pricing errors. By aligning the observation windows, the market achieves a synchronized settlement process that supports high-volume daily trading activity. The OIS curve provides a highly sensitive window into the market's expectations regarding future central bank monetary policy. Since the OIS rate represents the risk-free rate of return, its fluctuations are almost entirely driven by changes to policy rates and subsequent expectations of central bank actions. When a central bank signals a rate hike, the immediate impact is observed in the short-dated OIS rates because these instruments are tethered to the policy-sensitive overnight rate. This makes the OIS curve an essential tool for discounting future cash flows in derivative portfolios, as it removes the noise of bank-specific credit spreads. When we create a discount curve, we are essentially building a composite of OIS rates across various tenors to determine the present value of future obligations. For dealers, this provides a transparent, arbitrage-free environment for pricing credit risk-free instruments. Ultimately, the OIS market represents the cleanest indicator of the cost of funding for the most creditworthy participants in the financial system. See you in the next lecture. Welcome back. We are now moving into the nuanced world of cross-currency swaps, where we reconcile distinct interest rate environments across two different currencies. A cross-currency swap is a contractual agreement between two counterparties to exchange interest payments and principal amounts in two different currencies. Unlike a standard interest rate swap, where only interest cash flows are exchanged based on a notional amount in a single currency, these instruments involve the transformation of debt from one currency into another. Typically, the transaction begins with an initial exchange of principal at the spot foreign exchange rate. Throughout the life of the swap, the parties exchange periodic interest payments, often based on a fixed rate for one currency and a floating rate, such as LIBOR or a successor benchmark, for the other. At maturity, the principal amounts are re-exchanged, which effectively unwinds the currency risk associated with the initial principal commitment. This structure behaves like a sequence of forward exchange contracts bundled together with a loan agreement. Pricing these instruments requires more than just looking at the discount rates for each currency. You must incorporate the cross-currency basis spread, which reflects the supply and demand imbalance for liquidity in a specific currency pair. Because global financial markets are not perfectly integrated, the cost of borrowing one currency through the swap market may differ from the theoretical cost derived from covered interest parity. Therefore, the pricing formula must account for this basis spread, which is added to or subtracted from the floating leg to ensure the net present value of the swap equals zero at inception. If you fail to include this basis, your valuation will inevitably be incorrect because you are ignoring the premium paid for swapping one currency for another. This basis is effectively the price of the liquidity risk premium that exists in the cross-currency funding markets. To evaluate the cash flows, we must calculate the net amounts in their respective currencies, considering that these occur on different dates or involve different accrual periods. We utilize the covered interest parity theory to determine the equilibrium forward rate, but we must acknowledge that market friction often drives the actual market rate away from this theoretical ideal. Multinational corporations use these structures to match the currency of their assets with the currency of their liabilities, effectively hedging their balance sheets against adverse exchange rate movements. By locking in the exchange rate for both the interest payments and the principal repayment, the firm eliminates volatility. This approach ensures that long-term foreign currency funding remains cost-effective and predictable, which is essential for managing international debt portfolios. Counterparty default risk is another critical component that you cannot ignore when structuring these swaps. Because you are exchanging principal at both the start and the end, the credit exposure is significantly higher than that of a standard single currency interest rate swap. If your counterparty defaults, you might be left with an unhedged exposure in a foreign currency, potentially at an unfavorable exchange rate. Consequently, market participants often require collateral agreements or mark-to-market valuations to mitigate this risk throughout the term of the swap. In your professional practice, always analyze the creditworthiness of the counterparty alongside the interest rate characteristics of the contract. This multi-dimensional view allows you to see the true cost and risk profile of the transaction, which is exactly how you should approach your analysis for the exam. See you in the next lecture. Welcome back to our exploration of financial derivatives. In this session, we will focus on the nuanced world of derivative valuation and the credit-related adjustments that influence their observed market prices. When we talk about the valuation of over-the-counter interest rate and foreign exchange derivatives, we move beyond the idealized theoretical models to the practical realities of the modern markets. In a liquid market, the net present value of a swap is fundamentally determined by discounting projected future cash flows. However, the post-crisis environment has necessitated a shift toward a multi-curve framework. Unlike the pre-crisis era, where a single discount curve was used for all cash flows, we now distinguish between the index curve used to forecast future coupons and the collateral discount curve used to value the cash flows. This approach accounts for the inherent differences in liquidity and perceived credit risk between various instruments, which is essential for any professional managing these portfolios. Accurate valuation requires deep attention to how these forward curves are built and how they interact with each other in the discounting process. Beyond the basic present value calculations, the market clearing price of a derivative is significantly impacted by counterparty risk considerations. We introduce here the concept of credit valuation adjustment, or CVA, which represents the market value of counterparty credit risk. Essentially, CVA is an adjustment to the risk-free value of a derivative to account for the possibility that the counterparty might default on their obligations. To maintain balance, we also consider debit valuation adjustment, or DVA, which reflects the risk of our own default from the perspective of the counterparty. Furthermore, firms must account for funding valuation adjustment, or FVA, which represents the costs or benefits associated with funding the uncollateralized portion of a derivative trade. These FVA adjustments have become standard in professional desks because they reflect the true economic and capital cost of holding positions on the balance sheet. Counterparty credit mitigation techniques play a massive role in how these valuations manifest in actual trading environments. When parties enter into ISDA documentation, they are essentially creating a legal framework that governs their relationship and limits potential loss. Bilateral netting agreements allow parties to offset their exposures, significantly reducing the amount of credit risk that needs to be priced into the trade. Furthermore, daily variation margin collateralization shifts the risk profile of the derivative from unsecured to secured, which drastically reduces the CVA, as the collateral mitigates the exposure at default. By posting collateral on a daily basis, practitioners ensure that the movement in the market value of the trade is covered, thus aligning the real-time valuation of the instrument with the cash actually exchanged between the two parties. See you in the next lecture. Welcome back. In this lecture, we will establish the foundational vocabulary and mechanical properties of vanilla options to ensure you have a precise understanding of these derivatives before we move into complex pricing models. A vanilla option provides its holder with the right, but not the obligation, to either buy or sell an underlying asset at a predetermined price by a specified date. While the buyer gains this right in exchange for an upfront cost known as the premium, the seller, or writer, assumes the corresponding obligation if the holder decides to exercise. A call option grants the holder the right to purchase the asset, while a put option confers the right to sell the asset. The strike price, or exercise price, serves as the fixed transaction price regardless of the underlying asset's market value at the time of exercise. All options possess an expiration date, which represents the final timestamp after which the contract ceases to exist. Understanding this distinction between rights and obligations is the first step toward mastering the asymmetrical nature of option risks. The exercise style of an option dictates when the holder can invoke their contractual rights. American-style options allow the holder to exercise their right at any point up to and including the expiration date. In contrast, European-style options restrict the exercise date exclusively to the expiration date itself. This structural difference significantly influences the valuation of the option, as the flexibility associated with American styles carries its own economic value. Furthermore, an option's relationship to the current market price of the underlying asset determines its moneyness state. When an option provides immediate value upon exercise, it is considered in the money. Conversely, if the current market price is unfavorable compared to the strike price, the option is out of the money. At the money indicates that the underlying market price is precisely equal to the strike price. We must also decompose the premium into its two constitutive components, intrinsic value and time value. Intrinsic value represents the tangible profit one would realize if the option were exercised immediately, essentially the amount by which it is in the money. Time value reflects the premium the market assigns to the possibility that the option's value might increase before it reaches its expiration. As expiration approaches, this time value inevitably decays, eventually vanishing entirely on the final day. Professionals often refer to this as theta decay, which is a critical consideration for both buyers and sellers. When you pay a premium for an option, your potential loss is strictly limited to that initial outlay, regardless of how far the market moves against your position. This creates a defined risk profile that is fundamentally different from the underlying asset's price movement. On the other side of the transaction, the option seller faces a starkly different risk profile. While the seller receives the premium up front, they incur a contingent liability that can be substantial. For an unprotected or naked call option, the potential loss is theoretically unlimited, as the underlying asset's price could theoretically rise without bound. The seller must remain prepared to fulfill the obligation to deliver the asset at the strike price, even if they must purchase it in the open market at a significantly higher cost. Even with put options, the seller faces the downside risk that the asset value could fall towards zero, requiring them to purchase the asset at an elevated strike price. Managing these exposures requires a disciplined approach to collateral and market volatility assessments, which we will continue to explore throughout this module. See you in the next lecture. Welcome back, and today we are going to dive into the core mechanics of how we actually determine the price of an option. In the world of professional finance, we rarely rely on intuition when it comes to pricing derivatives, because intuition is often indistinguishable from guessing. Instead, we use quantitative models like Black-Scholes and the binomial pricing model to derive the theoretical fair value of an option. The Black-Scholes model operates on the principle of continuous time, making assumptions about log-normal distributions of asset prices, while the binomial model uses a discrete time framework to map out potential price paths. When you are sitting for the ACI 3I0-012 exam, you must be comfortable with the 6 foundational inputs that drive these models. These inputs are the current spot price of the underlying asset, the strike price, the time remaining until expiration, the risk-free interest rate, any applicable dividend yield or foreign currency carry cost, and finally, the implied volatility. Each of these variables is independent in the sense that they serve as the raw data for the computation, yet they interact dynamically to form the final quoted premium. If you understand how a shift in any one of these inputs influences the model, you effectively understand the engine that powers modern options trading. Let us dissect these inputs to understand the mechanics of premium movement. The underlying spot price is the current market value, and as it moves, it directly affects the intrinsic value of the option, which is the immediate profit if the option were exercised today. The strike price, by contrast, is a fixed contractual term that defines the anchor point for your potential profit or loss. Time to expiration is a critical component because it dictates the temporal value of the option, with options losing value as they approach expiry, a phenomenon we measure as time decay. The risk-free interest rate acts as the cost of carry for the position, which becomes particularly relevant in currency and equity options where the financing cost of the underlying creates a drift in the price. The dividend or foreign currency yield provides a balancing force, as payments made by the underlying asset during the life of the option will reduce the value of a call and increase the value of a put. Finally, implied volatility captures the market's expectation of future price swings. It is the most elusive yet significant input because it is the only variable that is not directly observable in the current market, requiring us to solve for it via the option price itself. To bridge the gap between these theoretical inputs and the real market, we must look at how premiums are decomposed into intrinsic and extrinsic value. Intrinsic value is the difference between the current underlying price and the strike price for options that are currently in the money, whereas extrinsic value is everything else. Extrinsic value represents the market's willingness to pay for the possibility that the option will move deeper into profit before it expires. When calculating these premiums, we often compute a volatility surface, which is a three-dimensional representation of how implied volatility changes across different strikes and maturities. Professionals do not assume that volatility is a single constant number across the entire board, but rather a spectrum where liquidity and market sentiment create a smile or skew pattern. Mathematical precision in these calculations allows a dealer to isolate theta or time decay from the directional risk. By understanding these dependencies, you gain the ability to strip away the noise of market fluctuations and identify whether a specific option is mispriced according to your model. See you in our next session. Welcome back. In this lesson, we explored delta and gamma to quantify how option prices react to changes in underlying market conditions. Delta is essentially the first-order derivative of an option's price with respect to the price of the underlying asset. When you look at an option's delta, you are measuring the expected change in the option premium for every 1 unit move in the underlying security. For a call option, delta ranges between 0 and 1, while for a put option, it ranges between -1 and 0. Many traders use this metric as a shorthand probability indicator, as the delta of an at-the-money option often approximates the likelihood that the option will expire in the money under certain volatility assumptions. Beyond pure probability, delta functions as the primary tool for directional tracking in a portfolio. If you hold a long position in a stock and want to hedge your directional exposure, you sell a specific amount of call options or buy puts based on the delta value. This adjustment process is fundamental to managing risk in real time, effectively neutralizing the market sensitivity of your overall position. By maintaining a delta-neutral state, a trader ensures that small movements in the underlying asset do not result in significant profit or loss fluctuations. While delta tells us the speed of change, gamma represents the acceleration of that change, functioning as the second-order derivative regarding the underlying asset's price. Gamma measures the rate at which delta itself changes for every 1 unit movement in the underlying. This metric is most critical for options approaching their expiration date, especially when those options are near the money. As the spot price approaches the strike price, the transformation of an option from out of the money to in the money happens quite rapidly, causing gamma to peak. Because high gamma indicates that delta is shifting quickly, it forces traders to adjust their hedge ratios more frequently to remain delta neutral. If you have a long gamma position, you naturally benefit from large, sudden moves in the underlying asset because your delta keeps increasing in your favor. Conversely, short gamma positions are inherently risky in volatile markets, as the rapid delta changes force a trader to buy high and sell low when attempting to maintain a hedge. Understanding the interplay between these two metrics allows for a deeper appreciation of the nonlinear risks inherent in derivative portfolios. Dynamic delta hedging strategies rely heavily on this constant interaction to keep a portfolio aligned with the trader's risk appetite. Because gamma modifies delta continuously as the underlying moves, a hedge that was calculated at the start of a trading session becomes obsolete once the asset shifts even slightly. This necessitates a continuous reassessment of the delta-exposed position, particularly in environments where liquidity is thin or market volatility is expanding. When the underlying price is stable, low gamma environments allow for slower, more deliberate adjustments to hedge ratios. However, as the expiration date draws closer, the gamma curve sharpens, leading to scenarios where a market maker must trade aggressively to offset changing delta profiles. It is this active cycle of buying to cover a positive delta jump or selling to offset a negative drop that sustains the market mechanism for risk distribution. By mastering the mathematical relationship between the first-order delta sensitivity and the second-order gamma acceleration, you gain the ability to predict how your portfolio risk will evolve as market conditions shift. Until our next session. Welcome back to our discussion on risk metrics. In this session, we will focus specifically on how theta, vega, and rho influence the valuation of options within a professional treasury environment. When we discuss risk sensitivity in options, we are essentially looking at the pillars that support the Black-Scholes model beyond simple price movement. Theta, often referred to as the time decay of an option, measures the rate at which the extrinsic value of an option disappears as the expiration date approaches. It is important to remember that this decay is non-linear, meaning that the closer an option gets to its maturity, the faster its premium erodes. For a holder of an option, theta represents a cost of carry, while for the writer or seller of an option, it acts as the primary source of profitable income over time. As a market participant, you must account for this acceleration, especially when dealing with short-dated instruments where the time value collapse becomes significantly more rapid. If you hold a long position, you are essentially paying for time, and your profit goal must exceed the cumulative theta effect to remain in the black. Vega measures the sensitivity of an option's price to changes in the implied volatility of the underlying asset. Specifically, it quantifies how much the option price will increase or decrease for every 1 percentage point shift in the volatility input. An increase in implied volatility generally leads to higher option premiums, which benefits those holding long positions, as the increased uncertainty makes the possibility of a large move more likely. Conversely, sellers of options generally have a short Vega exposure, meaning they benefit when volatility remains stable or declines, often referred to as a volatility crush, following a major market event. Understanding your aggregate Vega exposure is critical because it forces you to reconcile your portfolio with the market's current expectation of future price swings. You cannot effectively manage a trading book without recognizing that your premium value is constantly being recalibrated by the market's evolving view on risk and turbulence. Rho represents the final piece of this specific risk framework and measures the sensitivity of an option's price to fluctuations in the risk-free interest rate. While often less impactful than delta or vega in the short term, Rho becomes significantly more relevant for long-dated options or in environments where central banks are aggressively adjusting policy rates. The mechanism is rooted in the cost of carry. As interest rates rise, the cost to finance the underlying asset changes, which flows through into the theoretical model for option pricing. A call option generally has positive rho, meaning as interest rates increase, the premium rises, while a put option generally has negative rho. In practical application, you should evaluate rho whenever you are managing a portfolio with significant duration, as a sudden shift in the yield curve can introduce non-trivial adjustments to your fair value calculations. Mastering these three dimensions alongside delta ensures that you are looking at the full picture of your risk profile rather than just the directional exposure. See you in the next lecture. Welcome back. We are now entering the territory of multi-leg option combinations, where we move beyond simple long or short positions to more nuanced volatility strategies. When we discuss straddles and strangles, we are looking at instruments that decouple our directional bias from our volatility expectations. A long straddle involves buying both a call and a put option with the same strike price and expiration date. This setup is inherently a bet on realized volatility exceeding implied volatility, as the trader profits from a significant move in either direction. The break-even points for this strategy are calculated by adding the total premium paid to the strike price for the upper bound and subtracting it from the strike price for the lower bound. Because you are buying both types of options, the cost of entry is typically high, and you are essentially paying for the market to move beyond the boundaries set by the premium paid. Conversely, a short straddle involves selling both a call and a put at the same strike, which is the strategy of choice when one anticipates a stagnant market environment where volatility will decline. In a short straddle, your risk is theoretically unlimited because the price of the underlying asset could rise indefinitely, causing the call side of the position to incur massive losses. While you collect the initial premium from both legs, you are exposed to significant tail risk if the market performs a sharp breakout. This is why risk management in such a position often focuses on tight stop-loss orders or delta-neutral hedging adjustments. The maximum profit is limited to the premium received, which occurs only if the underlying asset expires exactly at the strike price. This scenario allows both options to expire worthless, enabling the trader to capture the full credit collected during the setup phase. As time passes, the theta decay works in favor of the short straddle seller, which explains why these strategies are favored when implied volatility is high and expected to revert toward the mean. Strangles offer a variation on this theme by utilizing options that are out of the money for both the call and the put. By choosing strike prices away from the current market level, the cost of entry is significantly lower compared to a straddle, which makes this an attractive tool for traders looking to manage capital efficiency. However, the trade-off is that for a long strangle to become profitable, the market must move a larger distance to reach the respective break-even points. The upside potential remains substantial if there is a violent move, but the range where the strategy loses money is wider than that of a straddle. For the seller, a short strangle provides a wider zone of profitability because the underlying asset has more room to move before either leg is tested against the strike price. This makes it a popular choice for traders who have a strong view that volatility will remain contained within a specific trading range. It is important to remember that these multi-leg strategies require constant monitoring of the Greeks, especially as the expiration date approaches. When dealing with premium erosion, the theta of your position will accelerate as the options get closer to maturity, which is a significant factor for short position holders. A long position, however, faces the constant pressure of negative theta, meaning the passage of time is actively eating away at potential profit unless the underlying asset moves sharply to offset the loss. Vega. The sensitivity to implied volatility also plays a critical role here because a change in market sentiment regarding future volatility can substantially alter the current mark-to-market value of your trade. Experienced market participants analyze these combinations not just as isolated bets on price, but as systems designed to harvest specific risk premia from the market. Understanding the interplay between these variables allows you to adjust your positions as market conditions shift, rather than remaining trapped in a static view of the original setup. I will see you in the next installment. Welcome back. In this lecture, we examine how corporate treasurers and institutional desks deploy multi-leg option strategies to manage exposure, specifically focusing on the advanced mechanics of hedging volatility and directional risk through synthesized structures. When we construct multi-leg option portfolios, we move beyond the simple directional bias of a single call or put, and instead focus on the net profile of our Greek exposures. A vertical spread, for example, involves buying and selling options of the same type and expiration, but at different strike prices, which effectively caps both the upside potential and the cost of the trade. By paying for a long call with the proceeds from a short call, we reduce the total premium outflow, a common objective for treasurers concerned with budgetary constraints. We must carefully monitor how the delta of this structure changes as the underlying spot rate moves toward the strikes within the spread. If the spot rate stays between the two strikes, the hedge remains effective, but a breakout beyond the short strike exposes the portfolio to unhedged risk if not managed correctly. These structures require constant assessment of not just the intrinsic value, but the way liquidity and volatility regimes might shift while the position is active. Calendar spreads take a different approach by exploiting the time decay, or theta, differential between options with different expiration dates while holding the strike price constant. In a corporate treasury context, this is often used to hedge a known future cash flow by selling the near-term volatility and buying the longer-term insurance. Because implied volatility is rarely uniform across the term structure, these spreads allow a desk to profit if the market realizes lower volatility in the short term than what is currently priced in. We pay close attention to the Vega profile here, as the hedge's effectiveness relies on the assumption that the term structure of volatility will behave in a predictable manner over the holding period. Should the market experience a significant shock, the correlation between time buckets can break down, forcing the manager to recalibrate the hedge to prevent an unexpected spike in gamma risk. Perhaps the most elegant solution for a risk manager operating under a strict budget is the collar, which combines a long put with a short call to neutralize the cost of the downside protection. When we structure this specifically as a zero-cost collar, we select strike prices that result in a net premium of exactly zero, meaning the hedge is funded entirely by the premium received from writing an out-of-the-money call. This creates a band of safety for the underlying asset, protecting the treasurer from catastrophic downside moves while forfeiting participation in extreme upside performance. Risk reversals represent a variation of this logic where one is long a call and short a put, essentially simulating an exposure to the underlying currency while skewing the risk profile towards specific volatility regimes. These structures are invaluable when trading in environments where the difference in implied volatility between calls and puts, is significantly high due to market fear. Managing these portfolios effectively means we must aggregate the net delta, gamma, vega, and theta across the entire book of multi-leg positions to avoid hidden correlations. It is a common mistake to view these legs as independent instruments, but in a market crisis, the liquidity of the short legs and the long legs may diverge significantly. For instance, in a tail risk event, the cost to buy back a short out-of-the-money call can skyrocket far beyond what a simple pricing model predicts due to the lack of willing counterparties. Therefore, institutional desks employ real-time monitoring to ensure that the delta of the entire strategy remains within the risk mandates defined by the committee. We analyze the net impact of these options on our total currency or interest rate exposure, treating the derivative overlay as a dynamic buffer rather than a static insurance policy. Ultimately, the goal is to optimize the premium spend while maintaining a robust protection level that accounts for the reality of nonlinear market movements. By layering vertical spreads or collars within a broader FX or interest rate hedging program, you build a synthetic insurance structure that is far more resilient than an outright forward contract. You must remain vigilant regarding the counterparty credit risk inherent in OTC option markets, ensuring your structure does not inadvertently create a massive exposure to a single debt issuer. Successful hedging in these advanced forms comes down to a disciplined, mathematical approach to balancing trade-offs between cost, protection breadth, and potential gains. As you advance toward the exam, remember that identifying the specific Greek profile of these combinations is just as important as understanding the directional utility of the hedge itself. See you in the next lecture. Welcome back. In this lesson, we examine market risk management frameworks, with a concentrated focus on value at risk and its practical application for the ACI 3I-0-012 exam. Market risk represents the potential for financial loss arising from fluctuations in the market prices of financial instruments. To quantify this exposure, practitioners rely on value at risk, or VAR, which provides an estimate of the maximum loss a portfolio may suffer over a specific time horizon at a given confidence interval. For context, if a portfolio has a 95% daily VAR of $1 million, it implies that, under normal market conditions, there is only a 5% probability that the actual loss on the next day will exceed that $1 million threshold. While this metric is structurally elegant, its utility depends entirely on the assumptions underlying the chosen methodology. For the examination, you must distinguish between the three primary methods used for these calculations: the parametric variance-covariance approach, historical simulation, and Monte Carlo simulation. Each method carries specific trade-offs regarding computational intensity, reliance on historical data, and sensitivity to the distribution of market returns. The parametric or variance-covariance method assumes that asset returns follow a normal distribution, allowing us to compute volatility and correlation parameters to derive the VAR. By constructing a variance-covariance matrix of all assets and their price sensitivities, we can aggregate risk across a portfolio while accounting for diversification benefits. This approach is computationally efficient, yet it fails significantly during periods of market stress because financial returns often exhibit heavy tails or leptokurtosis, which a normal distribution simply cannot capture. In contrast, historical simulation bypasses distributional assumptions by applying actual past market movements to current portfolio positions. This method assumes that the future will resemble the past, which makes it intuitive but potentially dangerous if the current market environment experiences factors absent from the historical dataset. Because it is non-parametric, it naturally incorporates the empirical correlation structure of the assets, including extreme events that actually occurred. Monte Carlo simulation represents the most sophisticated of the three methods, providing the highest degree of flexibility at the cost of significant computational resources. Unlike the other methodologies, Monte Carlo simulation generates thousands or millions of hypothetical price paths by sampling from defined probability distributions or stochastic processes. We then revalue the portfolio along each of these paths to create a comprehensive distribution of potential outcomes. This capability allows researchers to model complex path-dependent instruments, such as exotic derivatives, which are otherwise difficult to incorporate into simple parametric models. However, the accuracy of a Monte Carlo engine is entirely dependent on the quality of the underlying assumptions and the stochastic model selected for each risk factor. If the model incorrectly specifies the volatility process or fails to account for regime shifts, the resulting VAR measure may offer a false sense of security regarding risk exposure. Regardless of the methodology selected, VAR remains an incomplete measure of risk because it tells us nothing about the magnitude of losses beyond the chosen confidence threshold. This is why professional risk management necessitates the use of backtesting and stress testing to expose these hidden vulnerabilities. Backtesting involves comparing the model's predicted VAR with the actual daily realized profits and losses over a retrospective period to determine if the frequency of exceptions aligns with the projected confidence level. Stress testing, however, takes a more imaginative approach by simulating extreme, low-probability scenarios, such as a liquidity drought or a localized geopolitical shock. By intentionally breaking the model through these stress scenarios, risk managers can visualize the potential tail risk impacts that standard VAR metrics are mathematically designed to ignore. Maintaining a robust risk culture requires recognizing that while these metrics provide a common language for discussion, they are not a substitute for the cautious and rigorous assessment of market fragility. I will see you in the next lecture. Welcome back. And today, we turn our attention to the critical domain of credit and counterparty risk management within global financial markets. This chapter explores the precise mechanisms institutions employ to evaluate and mitigate the risks inherent in bilateral and cleared financial transactions. In the landscape of modern finance, credit risk management is primarily focused on the potential that a counterparty might default on their obligations before or during the settlement process. Pre-settlement risk refers to the exposure generated by the fluctuation in value of a derivative contract or financial instrument over its life, necessitating a forward-looking estimation of potential future loss. Conversely, settlement risk arises specifically at the moment of payment, where one party may deliver assets or cash while the other fails to perform as promised. A historical example of this is the Herstatt risk, which highlights the danger when transactions occur across non-overlapping time zones, preventing simultaneous exchange of principals. To manage these exposures, firms implement rigorous credit exposure limits, which act as hard caps on how much risk can be concentrated with a single entity. These limits are not static. They are dynamically adjusted based on the current credit rating of the counterparty and the prevailing market volatility. By monitoring these metrics continuously, risk managers can trigger collateral calls or stop trading activity well before a catastrophic event occurs. The International Swaps and Derivatives Association, known commonly as ISDA, provides the standard legal framework that governs the vast majority of over-the-counter derivatives. Central to this framework is the Master Agreement, which consolidates all individual transactions under a single overarching legal umbrella. This structure allows for bilateral closeout netting, a process where, in the event of a default, all positive and negative values of outstanding contracts are aggregated into a single net amount. Without such provisions, a non-defaulting party might be forced to settle all obligations individually while the bankrupt party fails to pay its debts. Linked to the master agreement is the Credit Support Annex, or CSA, which dictates the rules for collateral management between the involved parties. The CSA outlines the types of acceptable collateral, the frequency of valuation, and the threshold amounts that trigger additional security postings. This arrangement ensures that the credit exposure is collateralized, effectively reducing the net risk held by the non-defaulting firm to manageable levels. As we look beyond bilateral agreements, the industry has increasingly shifted towards central counterparties or CCPs to manage systemic risk. When a trade is cleared through a CCP, the central entity interposes itself between the buyer and the seller, becoming the buyer to every seller and the seller to every buyer. This process replaces bilateral counterparty risk with the risk of the clearinghouse itself, which is mitigated via high-quality collateral requirements and a mutualized default fund. While this reduces the complexity of interconnected daisy chain risks, it introduces a reliance on the clearinghouse's operational robustness. Furthermore, Modern accounting and valuation standards have introduced credit valuation adjustments, or CVA, as a standard pricing component. CVA effectively quantifies the market value of the counterparty credit risk, essentially asking what it would cost to hedge the risk of the counterparty defaulting. When a bank prices a derivative, it now includes the CVA spread to reflect the expected credit loss, ensuring that the price of the transaction reflects the actual cost of the credit risk assumed. See you in the next lecture. Welcome back. In this lesson, we will examine the mechanisms used to control and mitigate liquidity risk, which is a cornerstone of maintaining institutional solvency. Liquidity risk effectively represents the inability of a financial institution to meet its payment obligations as they fall due, without incurring unacceptable losses. To manage this properly, we must first distinguish between market liquidity risk and funding liquidity risk. Market liquidity risk arises when you cannot easily sell an asset at its fair market value because of a lack of market depth or disruptive price movements. Conversely, funding liquidity risk is the inability to settle obligations with cash or its equivalents when they come due, regardless of the solvency of your assets. These two risks are frequently correlated, as a market freeze can quickly force an institution into a funding crisis. When an institution cannot find buyers for its securities, the secondary market evaporates, leaving the balance sheet illiquid and incapable of generating the cash necessary to cover maturing liabilities. Basel III introduced specific regulatory metrics to standardize the approach to these risks, ensuring that banks maintain sufficient buffers. The liquidity coverage ratio, or LCR, is designed to ensure short-term resilience by requiring banks to hold enough high-quality liquid assets to survive a significant stress scenario lasting 30 days. These assets must be unencumbered and immediately convertible into cash without significant loss of value. On the other hand, the net stable funding ratio focuses on the long-term structural balance sheet safety. It requires that an institution's available stable funding be at least equal to its required stable funding over a one-year horizon. By balancing these two ratios, a firm addresses both the immediate threat of a cash run and the long-term danger of relying on volatile, short-term wholesale funding to finance long-term illiquid assets. Practically, control systems rely heavily on the construction of maturity mismatch ladders. This tool enables a bank to map out all cash inflows and outflows across various time buckets, such as overnight, 1 week, 1 month, and 1 year. By quantifying the net gap in each bucket, treasury desks can identify potential funding holes before they manifest. However, a static ladder is insufficient because it does not account for behavioral shifts in a crisis. This is where liquidity stress testing becomes essential. We must simulate idiosyncratic shocks, such as a localized counterparty credit event, and systemic shocks, such as a broad market seizing up. Through these tests, we assess how our liquid asset buffer behaves under pressure, essentially asking whether our collateral remains acceptable to central banks or if the haircuts are likely to widen dramatically. Finally, managing these risks requires a formal contingency funding plan to guide the institution during periods of acute stress. A contingency funding plan outlines the clear escalation procedures and identifies secondary sources of liquidity when primary funding channels are restricted. This might involve activating committed credit lines, selling specific tranches of the asset portfolio, or adjusting the bank's business model to prioritize liquidity over margin. The objective is never to eliminate liquidity risk entirely, as that would essentially require holding 100% of the balance sheet in cash. Instead, the goal is to manage the risk within a defined tolerance level, ensuring that the firm can sustain its operations during a severe systemic market freeze or a sudden, localized counterparty run. This framework provides the discipline necessary to navigate volatile environments without jeopardizing the firm's long-term viability. I will see you in the next lecture. Welcome back to our discussion on risk management frameworks. Today, we explore the critical domain of operational and reputational risk, which represents the non-financial threats that can undermine an otherwise profitable institution. Operational risk is fundamentally the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. Unlike market or credit risk, which are often quantifiable through historical price data or rating models, Operational risk remains highly idiosyncratic to the architecture of the firm. Common sources of failure often begin with internal fraud, where authorized employees circumvent established security protocols for personal gain or malice. Processing errors occur frequently in manual environments where human intervention is required, leading to settlement failures or incorrect accounting entries. System blackouts represent a modern existential threat, particularly as trading platforms increasingly rely on volatile digital infrastructure to facilitate high-frequency execution. Execution blunders, such as fat finger trades or misinterpretation of complex hedging instructions, can spiral into massive losses before internal monitors even detect the discrepancy. Assessing these risks requires a shift in perspective from probabilistic market models to the rigorous examination of process integrity and failure points. To mitigate these operational vulnerabilities, institutions must implement robust internal control systems defined by institutional checks and balances. The doctrine of segregation of duties serves as the primary defense, ensuring that no single individual possesses the authority to initiate, authorize, and settle a transaction. In a well-structured organization, the front office explores trading opportunities. The middle office validates the risk parameters and valuations, and the back office handles actual settlement and reconciliation. When these functions bleed into one another, the risk of collusion or unchecked error increases exponentially. Furthermore, clear business continuity plans are essential to ensure the firm survives a catastrophic event, such as a natural disaster or a large-scale cyber attack. These plans must move beyond mere documentation and require regular testing to ensure that critical functions can migrate to secondary facilities when primary systems fail. Reputational risk acts as a secondary, yet potentially more damaging, consequence of operational failures. An institution can recover from a liquidity crisis or a bad market call, but losing the trust of counterparties and regulators often leads to terminal decline in the global marketplace. This risk is deeply intertwined with regulatory and legal compliance, as a single high-profile breach of conduct can trigger heavy fines and long-term litigation. Monitoring for reputational risk requires a proactive culture of compliance, where employees at all levels recognize that their daily actions reflect the entity's brand value. It is not enough to simply follow the letter of the law. Management must foster an environment where integrity is prioritized over short-term gains. Maintaining reputational integrity involves constant vigilance, auditing of external communications, and the ability to pivot rapidly when a potential scandal threatens to undermine stakeholder confidence. Ultimately, managing these non-financial risks demands an integrated approach rather than a reactive one. The management team must treat operational incidents as diagnostic data points, systematically reviewing every mistake to update their control frameworks. By establishing comprehensive record-keeping and clear audit trails, the institution demonstrates both to itself and to its regulators that it possesses the maturity to handle complex financial operations. This rigorous oversight reduces the likelihood of systemic breakdowns and helps clarify the boundaries between risky but valid business activity and negligent behavior. Consistency in applying these frameworks is the hallmark of a resilient institution that can thrive even when individual processes encounter friction. If you neglect these structural pillars, no amount of sophisticated hedging or market analysis will prevent a collapse when the internal machinery inevitably encounters stress. I will see you in the next lecture. Welcome back to the course, where we turn our attention toward the systematic management of the banking balance sheet. In this session, we will examine asset liability management, or ALM, as the primary framework that banks utilize to optimize their risk-return profile. Asset liability management is essentially the art of managing the bank's balance sheet to ensure that earnings are stable despite fluctuations in market variables. At its core, an ALM desk is tasked with balancing the maturity profiles of assets and liabilities while maintaining an acceptable risk appetite. When a bank accepts short-term deposits and channels them into long-term loans, it naturally creates a structural mismatch. This maturity transformation is how banking functions, yet it exposes the institution to significant interest rate and liquidity risk. The ALM function exists to identify, quantify, and mitigate these specific risks using both structural adjustments and derivative instruments. Without a rigorous ALM process, a bank would be essentially gambling on the direction of interest rates rather than providing financial intermediation. To effectively monitor these risks, practitioners rely on gap analysis models that categorize assets and liabilities into specific time buckets based on their repricing dates. By calculating the difference between rate-sensitive assets and rate-sensitive liabilities within these buckets, the ALM desk can determine the bank's exposure to rate movements. If a bank has more rate-sensitive assets than liabilities, rising interest rates will generally increase the net interest income because assets reprice upward faster than the cost of funding. Conversely, falling rates would compress this margin, necessitating a hedge. This is where duration matching comes into play. It is a more nuanced approach than simple gap analysis because it considers the sensitivity of the cash flow timing. By aligning the duration of assets with the duration of the liability portfolio, the bank creates a cushion against economic value volatility. Another vital instrument in this toolkit is internal transfer pricing, which allows the central treasury to charge or credit business units for the risk they offload. By centralizing the interest rate risk of disparate loan and deposit products into the ALM desk, the bank gains a holistic view of its structural exposure. For example, if the mortgage department originates long-term, fixed-rate loans, the Treasury might charge them for the duration risk while effectively swapping that risk into a floating rate for the desk's own management. This internal market ensures that the bank's frontline business units focus on product pricing and customer acquisition, while the Treasury handles the macroeconomic hedging. These internal prices must accurately reflect the opportunity costs of capital and the liquidity premiums associated with different asset classes. Managing liquidity is equally critical, as the ALM desk must ensure that the bank can meet its obligations even during periods of market stress. This requires constant tracking of inflows and outflows, often through liquidity stress testing, under scenarios ranging from mild market turbulence to full-scale liquidity crises. The ALM committee uses this information to determine the appropriate liquidity buffer, deciding which assets are liquid enough to be sold or pledged as collateral at a central bank. By managing the maturity mismatch through wholesale funding and repo markets, the bank ensures that its deposit base is not over-leveraged. Balancing the yield gains of long-term assets against the necessity of short-term liquid cash remains the fundamental balancing act of the treasurer. The impact of these decisions is formally tracked through two primary lenses: net interest, income sensitivity, and economic value of equity. Net interest income focuses on the short to medium-term profit trajectory of the bank under various rate scenarios. If the ALM process is robust, the bank's income should remain within a predetermined band even if market rates shift by 200 basis points. Economic value of equity, on the other hand, takes a longer view by discounting all future cash flows to the present to assess the impact of rates on the bank's total market value. A drop in interest rates might temporarily boost earnings, but the concurrent rise in the duration of assets could plummet the economic value of equity if not properly managed with hedges. Derivative instruments are the final and perhaps most flexible component used to achieve this structural alignment. Interest rate swaps can effectively transform fixed-rate obligations into floating-rate ones, or vice versa, to match the desired risk profile of the balance sheet. By entering into these contracts, a bank can insulate its earnings from adverse macroeconomic fluctuations without needing to alter its core loan or deposit products. This is not about speculation, but about precision. The goal is to neutralize the structural risks that the bank acquired through its ordinary operations. Through the rigorous application of these principles, the ALM committee transforms a volatile collection of banking contracts into a stable and predictable engine of financial performance. I will see you in the next lecture. Hello, and welcome to this session on the Basel Accords, a cornerstone of global financial regulation. In this lesson, we will systematically break down the structural evolution and the functional elements of the framework designed to ensure institutional stability. The Basel Accords represent a series of international banking agreements established by the Basel Committee on Banking Supervision. While Basel was essentially a foundational attempt to link capital requirements to the credit risk of assets, the framework evolved significantly into Basel II and Basel III to address more complex systemic vulnerabilities. When you are analyzing these requirements for the exam, it is vital to view them not just as static rules, but as an integrated system of risk management. The architecture is defined by the three-pillar framework, which balances quantitative constraints with qualitative oversight and transparency. Understanding why these pillars were added in succession helps in remembering how each layer addresses a different layer of potential banking failure. You should maintain a focus on how these regulations constrain the balance sheet to prevent the insolvency of global financial institutions. A firm grasp of these structural components is essential for addressing the technical questions you will face. Pillar 1 is the most tangible aspect, focusing on minimum capital requirements for credit, market, and operational risks. This pillar essentially mandates that banks hold enough capital to survive foreseeable losses, categorized as Tier 1, which consists of common equity and retained earnings, and Tier 2, which covers supplemental capital like subordinated debt. Basel III introduced stricter definitions for these capital tiers and added specific requirements for common equity. Tier 1, to improve loss absorption capacity. Beyond mere ratios, you must account for the leverage ratio, which serves as a non-risk-based backstop to prevent institutions from overextending their balance sheets. We also see the introduction of macroprudential buffers, such as the capital conservation buffer and the counter-cyclical buffer, designed specifically to dampen the volatility of the economic cycle. These quantitative requirements act as the primary engine of the regulatory framework by ensuring that every asset is underpinned by a specific layer of loss-absorbing capital. Pillar 2, known as the supervisory review process, shifts the focus from hard numbers to the adequacy of a bank's internal risk management. It requires institutions to conduct their own internal capital adequacy assessment process to determine if they need more capital than the Pillar 1 minimums based on their specific business models. This gives national regulators the authority to intervene and mandate higher capital holdings if they believe the bank's risk profile deviates significantly from the industry norm. This pillar acts as a critical bridge between simple compliance and strategic risk management, acknowledging that automated formulas cannot capture every possible scenario. You should consider this the qualitative safety valve that accounts for risks that are technically difficult to model or quantify. It places the burden of proof on the bank to demonstrate that its capital management is robust enough to handle its specific risk exposures. Pillar 3 focuses on market discipline, relying on public disclosure mandates to keep banks honest through transparency. By requiring detailed reporting of capital positions, risk exposures, and governance frameworks, it allows market participants to evaluate the relative strength of different financial institutions. This transparency forces boards of directors to act more cautiously, knowing that their risk management choices are visible to peers, investors, and creditors. From an examination perspective, think of this as the enforcement mechanism that uses the power of the market to complement the actions of regulators. It is not enough for a state authority to know the risk levels. The broader market must be sufficiently informed to price that risk correctly. When you think of Pillar 3, visualize a marketplace where disclosure provides the information necessary to discipline the behavior of individual institutions. I look forward to discussing the next topic with you. Welcome back. It is time to consolidate our understanding of the ACI Dealing Certificate syllabus before you step into the exam center. We have traversed a complex landscape ranging from the granular mechanics of day count conventions to the high-level architecture of the Basel Accords. At this stage, your primary goal is not to relearn every formula, but to recognize the structural patterns that define the ACI 3I0-012 exam format. When you encounter a question regarding interest rate math, your first instinct should be to identify the day count convention, because an incorrect basis often leads to a plausible but structurally wrong distractor answer. Similarly, in foreign exchange, ensure you keep the price and base currencies distinct throughout your calculation to avoid the common trap of inverted swap points. Think of your spreadsheet preparation not as a crutch, but as a mental model for how the market reconciles spot rates with carry costs. If you find yourself spending more than 90 seconds on a single calculation, mark it for later and revisit it only after you have secured the easier points elsewhere. Effective exam performance relies on your ability to map qualitative ACI Model Code guidelines to quantitative risk management scenarios. The exam frequently tests your understanding of counterparty risk by asking how specific liquidity operations or repo margins should be applied under changing market conditions. Remember that while the math may change between simple discounting and derivative pricing, the underlying principle of non-arbitrage valuation remains constant. When you look at an option strategy, convert the terminology back into its delta or theta components to see if the exposure makes sense in a risk-neutral context. If a question feels ambiguous, look for the most conservative application of market risk metrics, as the ACI certification prioritizes prudent practice over aggressive speculation. Your internal checklist should explicitly confirm that you have double-checked the settlement dates on all forward or swap calculations before committing to a final answer choice. Time management within the 2-hour window requires a disciplined approach to the computer-based testing environment. You should dedicate the first few minutes to scanning the question bank to identify low-hanging fruit where you can apply standard formulas with minimal friction. Avoid the temptation to perform manual, long-form arithmetic when simplification or intuition can rule out 3 of the 4 options immediately. During the final review, focus your mental energy on the specific interactions between currency carry and interest rate differentials, as these often serve as the bridge between the foreign exchange and derivative modules. Maintaining this level of focus requires a calm approach. If you solve for a variable and find a negative value where a positive one is expected, do not panic, but instead reevaluate your base and quote currency sequence. This systematic approach effectively neutralizes the anxiety of the testing environment and shifts your focus to the purely mechanical requirements of each question. I wish you the best of luck with your final preparations.